Friends, good evening. Welcome you to the day 2 of this A to Z of GST annual return and GST audit. Probably yesterday we covered from A to M. Today Shankar will take from N to Z, the day 2 where he's going to cover things on GST audit 9C, where the role of chartered accountants is immense and he plays a major role because the first thing is they have to correct in the returns within the financial year. Whatever they miss, they have to cover it within 30th September of the next year. Whatever that gets missed, you have to cover in GSTR 9, which was covered by Ganesh yesterday. So the final ball where things have to be taken care, after which there is no other chance where you could do it is GSTR 9C, one of the most important thing because it is the attest function done by a chartered accountant where he certifies that everything is fine. So we rightfully thought that we'll have one exclusive session because initially we thought of having this both in one day, but then when I had a discussion with Ganesh and Shankar, they said no, if you want to cover from A to Z, really we'll have to split it into 2 days so that we can kind of do justice to the topic. So I welcome Shankar, who is going to touch upon take the chapter of this 9C, and I also take this opportunity to welcome CA Chinnamastan, our chairman of the Indirect Tax Committee. Every month there are at least 2-3 programs where we ensure that GST is part of it. There's one more advanced GST which we planned. For other reasons, for the date clash, we could not do it this month, which we will be taking to the next month. Before I request Abhishek to introduce the speaker, I request CA Chinnamastan to give the opening remarks.
Yes, sir. Thank you, Chairman. And the Chairman of SARC, my best friend ECJ, and the Secretary of SARC, Abhishek Murli, and today's speaker, CAB Shankar Narayan, and my dear members who joined this virtual webinar. Good evening to everyone. Dear members, myself as introduced by our Chairman, Chinnamastan Regional Council member from Hyderabad. Once again, I welcome you all for this second day refresh course on A to Z. That's as Chairman expressed, yesterday is completed up to M. So now we start from N to Z today. That is the more important topic is GST annual return and GST audit. Members, everybody knows nowadays, every member who are in the practice, most of them are getting calls from the clients regarding the GST. And the clients also don't know exactly the due dates and especially the due date for the annual return and the GST audits. So we should update, we should give the awareness to the clients so that we'll get that professional assignment and we'll save the client to avoid this all these penalties and the compliances. Members, GST is the one nation and one tax, everybody knows, a nice tagline. But when it comes to the implementation, somehow I understand the executive is facing a lot of glitches. It is informed from the way that time extension are granted in filing many returns, including the annual returns and the audit reports. Anyway, that's GST audit is definitely an excellent avenue for the chartered accountants, but at the same time, we must exercise due care identifying the difference between the GST statements filed and the revenue declared as per the finance statements to avoid unwarranted notices from either from the direct tax department or indirect tax department and report the same in the GST audit report. Members, coming to the other updates, I want to share interestingly the MEF application for the 2020-21 likely to be hosted by this before 25th of August. And one special changes it is coming in the coming MEF application. As per the RBI guidelines, RBI notification, there is 4 category of the forms. One is the category 1, 2, 3, and 4. This is the classification done by the RBI. But in the category 4, who having most majority is the proprietors, there is a change. In the notification, it is saying that the proprietor must be a proprietor and one paid CA. Then only we will get that category 4. So this most of the proprietary firms not having that conditions. This condition it was from last 4-5 years, but somehow that we are not implementing that condition as from institute side. But it's now specifically RBI giving direction. It must implement in the MEF application itself, so that it's filtering at the MEF application at the initial stage. But once if that condition implement, the out of as of today 22,000 category firms in India, but 99% of the firms will be ineligible. So this is very difficult. The institute either has to implement or postpone. Postpone is not a right, not a decision at the institute level, but at the RBI level. So it's a negotiation going on, but still decision might become it's a few days after. But my suggestion to all the category 4 firms, so you should invite that any partnership converting into proprietary into partnership, or keep that one paid assistant as a CA. But again, it's a condition. It's saying that for the MEF 2020-21, this paid assistant and proprietor should have the date is in the 31st December 2019. Even if the institute will ask today, but it's not possible to implement now. So it may not be practically not possible to implement for 2021, but it definitely it required institute mandatory implement next year. But before December 2020, you should go for the comply this provision. We can save, we can comply for the at least 21 and 22. So that is my suggestion. It's the latest update. And coming to that, I expressed so many meetings regarding the insurances, either for the institute members and family members, and especially for the article students who are working under us. So we are the responsible to keep that their health in good condition. So take that for the, especially for the student, for paying that 800 rupees, we will get 2.5 lakh. With that New India Assurance and ICA, there is a website, ICA newiindiaassurance.org. We can go simply, we will get, so that we can reduce our burden by paying that 800 rupees for the students. This is my suggestion. Members, don't go for the away for anyone, maybe especially in the travels. Members are practice members, especially more interested to go for the traveling. But I request you, don't go for that. Our audit is, our professional work is the like a going concern. It will going on. So going concern never break. It is a continuous activity. Whenever the business is so long is in the society. So my request is keep in the house, be in the house or the office, and save our family and our society. Thank you, Anadal, giving this wonderful opportunity. And Shankar Narayan is the right person to take this GST audit and everything. I hope the every members will get the good benefit on this topic. Thank you so much.
Thank you so much, Chinna Mastan. In fact, Chinna is in our council one. We call him as PDC man. Any doubt you have on PDC, or you kind of have to, things plan in a better way, you can reach him directly. He is one who will give you the perfect advice to take care of things. Thank you, Chinna, and also for updating us through the various initiatives of ICA. Abhishek, over to you to introduce the speaker formally.
Thank you, Chairman. A very good evening to all the viewers who have joined in today. Good evening to our dynamic Chairman, C.A. Dungarchand Jain, Chinna Mastan, Chairman of our GST committee, who gave a very lovely introduction, and of course our speaker for the day, C.A. Shankar Narayan, my good friend. Now, before I introduce the speaker, as Chinna Mastan rightly touched me, he set the tone for the event, not only about GST, but he also shared updates, which is MEF is coming around the corner. Chairman and I have also been in discussions about this, and in fact we have planned a program at the end of the month where we want how firms should network, how you should merge, what are the conditions, how you will comply with ICA requirements, so that empanelment, be it for your C&AG audit, your central statutory audit or branch audit, whatever it is, lot of opportunities present itself, as Chinnamastan rightly said, when you have more chartered accountants in the firm, be it as a partner or as a paid assistant, however you want to structure it. So what are the opportunities? How you should go about it? You are a new firm, you want to merge with an old firm, whether you should do in the new firm name or whether you should do in the old firm name. All of these are practical challenges people are confused with, and there are a lot of opportunities which are present today. So we have planned a program. I think the date is to be finalized. We are planning
No,
31st.
it is August 31.
31st? Okay, 31st of August. It has been confirmed. We've got a very reputed speaker from Bombay who will be joining us on that date. So I just thought I will share this now. Also now, I have the privilege of introducing our speaker, Shankar Narayanan, who will be taking us through on GST audit. And I will now introduce him formally. He is a chartered accountant and a cost and management accountant with almost 20 years experience in finance and taxation. His compliances experience spans across diverse sectors, including banks, service sector, manufacturing, and he has a special focus on indirect taxation, be it GST, customs, or foreign trade policy. He's a person who is a very active contributor for the professional interest. He is a member in various circles, member of the GST study group, master trainer of the GST, contributor for the background material on GST. He has trained more than 2,000 chartered accountants and more than 6,000 finance professionals and accounts professionals across country. In fact, he is a member of the Governing Council and currently the secretary of the International Chamber of Indirect Tax Professionals. He's a natural leader. I have seen him organize programs, how he brings together more than 300, 400 people in a very short span of time and does a lot of service. He's a person who's authored several books on GST, and he's a speaker trainer, very well sought after, be it by the ICAI, the Cost Accountants Institute, the Company Secretary Institute, the NASIN, Regional Training Office of the CAG, and the list goes on. As I said, he is a true leader also, and I have had the experience of seeing it firsthand. A very nice speaker, very down-to-earth person. He always has some humor also, along with his knowledge. So it is always enjoyable listening to him. Looking forward to your session, Shankar Narayan sir. I'm sure many chartered accountants here facing practical difficulties of GST, where you look at your GSTR 9, you see some figures, you fill it in the 9C, for some reason it does not accept. So maybe you will also give us some update, because till the last step, when we go and put submit, we don't know what error is there and we have to download a form, etc. So please do throw light. I am sure that your session will take us through that in your impeccable presentation manner. We are all looking forward to it. We welcome you, Shankar sir, for taking time out of your schedule.
Yeah, and I must make one more mention here, Abhishek, that whenever we need to structure out some GST programs, this Ganesh Prabhu and Shankar who comes help to structure it in such a way that the best is we are able to do it for the members.
Absolutely.
Shankar, over to you, please.
Thank you. Thank you, Chairman DC and Abhishek Chinnamastan sir, and the members who are gathered for the session on a Gokulashtami evening. Still, I can see that even before we started the session, 3 questions have come in the Q&A. That shows the amount of interest or the questions that remain to be answered when we discuss. So that is why I have comfortably placed my presentation for about 2.5 hours maximum. So I'll take a lot of questions towards the end of my presentation. That is the idea. Actually, the 3 questions that have come, I have put it as a question in my presentation also for us to discuss and maybe take a stand towards the end of my presentation. So with that assurance, I think I'll start off my presentation. Just give me a minute, I'll share my screen. Yeah. As the name that we coined, that A to Z, DC had suggested we'll threadbare analyze it, Shankar, and then we'll be able to tell people, we should be able to tell as to somebody who's a first timer looking at GSTR 9 and 9C, what he should do, or what are all the things that need to come into that. That is what is the idea, and that is not the only perspective that which I'm going to discuss today. There are issues, there are things that whether how it needs to be reported or how this needs to be handled, even those we will see as we go by the form. Now, when it comes to GST audit, one of the key questions in various other forums also, where we have had discussions, in fact, I would say a lot of discussions, in some cases it has even become difference of opinion, which is because of the definition of the word audit. The word audit, which is defined in the CGST Act, Section 2, subsection 13 defines the word audit, and it has two major parts. It says, one, it is an examination of the records, returns and other documents which the assessee is maintaining either under this act or any other act for the time being in force. So we are supposed to do an examination, and then the subsection 2 subsection 13 goes on saying it is also involving a verification process. So an examination and a verification process of the turnover that is declared, the tax that has been paid. The turnover, the tax could also involve the input tax credits involvement and the refund that has been claimed by the assessee to assess the level of compliance done by the assessee. So the GST audit, the word audit as defined under the GST Act covers this much. Why we should go through this, as it has been repeatedly told, or the one part of the press release which has been given by the department earlier leads us to a conclusion that reconciliation statement shall only be our scope, or the reconciliation statement is the end of GST audit. So that is where I have a view that the word audit under GST has to be read separately, and the reconciliation statement is only a part of the compliance that which we are supposed to do. Hence, the definition under 2 subsection 13 will set the context for the discussion. Now, what do we derive out of this? When we look at the examination and verification aspect, are we supposed to do it? Yes, because the audit says that. The GST audit definition says that we are supposed to do the examination and verification. And then we are supposed to provide a reconciliation statement. So two things. Audit involves examination and verification. And as per section 35 subsection 5, we are supposed to provide a reconciliation statement. Effectively, that would mean that is what is the audit that is contemplated in 35 subsection 5. So reconciliation statement alone is not audit. So reconciliation statement only if we think that is what is audit, we are wrong. Examination and verification, scope and objective is also vested upon us, plus the reconciliation statement. We will see the part B of GSTR 9C. When we go through the certifications, I'll be able to point out the places where we are becoming responsible when we are signing the GSTR 9C for certain assertions which are given in the part B to the GSTR 9C, the certification part. But this is the first part I want to clarify, that am I responsible only for the numbers which are appearing in 9 to be matched with the accounts for that particular registration and give a reconciliation statement? Yes, that is also part of the work that we are supposed to do as per 35.5, but actually it involves the examination verification also. Now to just look at the legal background of it, 35.5 says this much, that the turnover during a financial year exceeds a prescribed limit. The assessee should get, the taxpayer should get the books audited by a chartered accountant or a cost accountant and shall submit a audited accounts and the reconciliation statement, which means the audit is one part and the reconciliation is the other part. So the legal background for me saying that audit is one activity and then giving the reconciliation statement, which is the output of that audit, and that is not the only objective of the audit, is again reiterated in section 35 subsection 5. And what is this limit? Has there been any change in the limit? Yes, we have had some changes for 2017-18. But when it comes to audit under GST, the other aspect that we have to be aware of is like a tax audit. In case of an income tax audit, GST also, there is a possibility that a statutory auditor could be the GST auditor. If the statutory auditor, the auditor who is doing the audit of the accounts of that organization, it could be a company or it could be a partnership or any other kind of organization, either under the Companies Act or either under the Societies Act or under the Income Tax Act, they are subjected to an audit. So that auditor, I'm calling him as the statutory auditor. A person who is liable to get audited under any other law other than GST shall come under the category of statutory auditor. If that is the person who is doing the GST audit, then what happens cumulatively is the examination and verification part is taken care in the statutory auditor scope. So they are supposed to give the detailed outlook as to this is what I have examined, these are I have verified, and I have got these are my observations and these are my qualifications. That has to come from the statutory audit, and then as a GST auditor, they will be submitting a reconciliation statement. So there are two parts which are both satisfied by a GST auditor if he is also going to be the statutory auditor. Majority of the cases would fall under this category where we are the statutory auditor and we are also doing the GST audit. But in some of the cases where we are not the statutory auditor, that is, I'm looking at it from the perspective of GST audit, where we are the GST auditor, but we are not the statutory auditor. In those cases, what we are supposed to do when we are giving our assertions in the GSTR 9C Part B as a certification, when we are giving it, we are forced to rely on the work done by the other auditor. That is, we are supposed to say, this is the balance sheet and P&L which has been examined and verified by the statutory auditor, and this is the name of the statutory auditor, this is the person who is signing, this is the firm name and all that, and then we are supposed to give a reconciliation statement. Now, in this case, I would say, yes, reconciliation statement is only our scope, but even in this case, that is where we are only the GST auditor, we are not the statutory auditor, our responsibility does not stop at a situation when we are doing only a reconciliation statement. Even a certain amount of, the reason I have put it small in size is, it is not an enlarged scope, but a restrictive scope of examination and verification shall also have to be done by us. So even if I am going to be only a GST auditor, I cannot exonerate me from the responsibility stating that there is no examination verification which is within my scope. I will do only my reconciliation statements. I don't think so, because we also have that responsibility. If you are going to be the statutory auditor and GST auditor, you have got the complete responsibility to do the verification, examination, and the reconciliation statement. So this is the objective of doing this audit. Now, before we get into the process of audit and the discussion around that, I would request you to go through the technical guide, where it is not to read every provision, where in the technical guide, annexures have been provided for the format of engagement letter, the engagement letter that we need to take, the management representation letter that we need to take, the possible scenarios, and what are the assertions that are given by the management saying that this is something which we are aware and this is what I wanted to handle in the accounts, or this is how we want to handle in the accounts. Please get those from the technical guide and appropriately modify it, and get the engagement letter as well as the management representation letters from the while performing this audit, because even this comes under the scope of auditor. So as we are doing an audit, here also we are supposed to maintain that the level of documentation for the purpose of any reference in the future. Hence, the engagement letters and the management representation letters for any decisions that are taken or based upon which we have relied, please seek those two. And the formats, as I told you already, it is there in the technical guide published by the institute as an annexure. You may download it, convert it, copy paste it in a Word document and use it. So this is from a perspective of every client which we are adopting for, which we are taking for the purpose of GST audit. This adoption of management representation letter and engagement letter shall have to be done case wise. Now, section 35 subsection 5, that is the only section which talks about the GST audit by a chartered accountant. There is another section, but that is talking about the audit by the department. So this section 35 subsection 5 also has an exception. Scenarios when the GST audit would apply at all. Now, yesterday, Ganesh would have taken you through the type of assessees for whom GSTR 9 is not applicable. When GSTR 9 is not applicable, the obvious fallout is that GSTR 9C cannot be filed for them, because reconciling the numbers filed as per GSTR 9 only with the books of accounts. So that is not going to happen if that person is going to be a person who is not liable to file GSTR 9. For example, an input service distributor or a person who is doing TDS TCS. For that purpose only, a registration has been taken, then they need not do this GST annual return in those cases. 9C is also not there. Apart from that, so what we are going to discuss here is a situation where GSTR 9 is there, 9 is mandatory, but 9C is not required. So this is a situation, or these are two situations where 9 is required, but 9C is not required. That is, any department of the central government or state government, specific department, let's say education department, any such department by the central government or state government, or any local authority whose books are audited by the C&AG, Comptroller and Auditor General of India, or any auditor appointed by the government for doing the local authorities audit. If this two audits or any one of these two audits are going to be upon them, the department of the central government or state government or a local authority, what are we supposed to do? The GSTR 9C, that is the audit under section 35 subsection 5 and the reconciliation statements are not applicable. Hence, these two situations, we will see that there is an applicability of 9, but there is no applicability of 9C, an exception carved out at the section level itself. Okay, moving further, audit by a chartered accountant, 23rd March 2020, there was a amendment to Rule 80 Sub Rule 3. A slight change to our income projections for the current year. Post 23rd March, we had to do a lot of change to our income projection. But 23rd March, income projection had to be slightly changed for chartered accountants because the limit for 2018-19 GST audit was enhanced from 2 crores to 5 crores. So earlier, that is for 2017-18, a person who had 3 crores of turnover had to do GSTR 9, had to do GSTR 9C. So 9 he would have done, 9C we would have certified. This 9C, since the turnover was 3 crores, it was above 2 crores. So the GST audit was applicable and mandatory. But 23rd March 2020, in an effort to make things easier for compliance in GST, the government decided, and through the amendment to rules, the CGST rules, a proviso was inserted to Rule 80 Sub Rule 3 stating that for 2018-19 only, a ray of hope is also there, because for 19-20 we might return back to 2 crores. For 18-19 only, the limit is fixed at 5 crores. So the limit which is contemplated in section 35 subsection 5 delegated to the rules, it was earlier reading as 2 crores, but for the financial year 18-19 only, it has been increased to 5 crores. So only for this year, this is how it is going to be. So assessee with more than 5 crore turnover, taxpayer, or I would say any as taxpayer with an aggregate turnover of more than 5 crores only, GST audit is applicable for 2018-19. And what is aggregate turnover? Just a quick refresher. Anything which is done all India basis for that PAN. So it is not one registration only data. It is across India for that same permanent account number. What happens to be there? Total supplies. It could be taxable supplies. It could be export goods or services or exempted supplies, any which category, except even the turnover which is done on behalf of others, like an agent who is doing a transaction, except the one which is a turnover on which I am liable to pay GST under reverse charge. That is my inward supply on which I am liable to pay GST under reverse charge. That need not form part of my turnover. GST per se need not form part of my turnover. The tax under GST need not form part of my turnover. So keeping these two away, the remaining part of my turnover shall be considered for the purpose of calculating this 5 crores. Aggregate turnover is determined in this way only. And as you would have seen in the last couple of weeks, there have been emails coming to all the registered persons, automatic emails from the department. Now, this 5 crores in all probability is going to be used across various forums in GST itself by the department as a level fixed for the classification of assessee. Now, even you would have seen that they are going to bring about some changes in the new returns, which was proposed in April, pushed to October. Even in those returns, they had said that if your turnover is going to be more than 5 crores, then monthly return is mandatory. But if your turnover is going to be up to 5 crores, we are going to make it as a quarterly return, optional. Now, these are the things that are going to come. Hence, These automated mails have been sent by the department asking the assessee to assert whether your turnover is actually more than 5 crores, because as per our books, it is more than 5. Do you agree that it is more than 5? They have started asking this question because of this 5 crore limit only. So if there is going to be a difference, for example, we have reported taxable supply, but the taxable supply reported was on account of advance, because in 3B, when we are reporting, we report it in the first line, which is outward taxable supplies. It includes advances also. Technically speaking, on advances, the time of supply occurs earlier, but it is not a supply. So because of advance, my that year turnover is 6 crores, but it is because of 2 crores worth of advance. Then there is no need for me to even get GST audited. I cannot be told as a person who is having a turnover more than 5 crores. So I think that is where we may have to action. And those assessees who has been classified as more than 5 crores, I believe all of them will come under the category of GSTR 9C also. Hence, that automated mail. So you may have to respond back. You may have to initiate any response only if you have a dispute with their turnover classification. If you are way above this 5 crore limit, I don't think we have to do anything with respect to that. And GST audit is also certain upon you. And when we look at GSTR 9C per se, the return, the reconciliation statement is part A, and the part B contains the certifications. In part A, we have the basic details in part 1, and part 2 contains the turnover. Now, 3 things only we are reconciling. Let's look at a macro level before we approach, because what happens is once we start seeing the table, we get lost into this and we think, what are we reconciling? Before that, I wanted to simplify in terms of only 3 parts are there. In any indirect tax, there are only 3 parts: output tax liability, input tax credit, output minus input, tax paid. That's all. So we are going to reconcile only these 3. My output tax liability, my input tax credit, my tax paid. Tax paid is obviously as per the returns, because I would have paid the tax only to the government. Hence, what I show in the return as paid is only to be considered. Whereas input tax credit and output tax liability, I have a possibility of showing something in the books, and I have a possibility of showing something else in the returns. So when it comes to tax paid, there cannot be a deviation. Tax paid is what has been paid through the return or through either method. What has been paid is, it is there to be taken only from the GST portal. But when it comes to my output tax liability or input tax credit, there is a possibility that I can show a different number in the books of accounts. Either more ITC taken, lesser ITC taken, more output tax liability shown in my books, adjustments done to my turnover because of accounting standards requirement. Many such things could arise. Hence, the reconciliation is only 3 major heads. In that also, I would eliminate the taxes paid from the reconciliation part 3. Please think that there are only 2 parts that we need to reconcile. How to reconcile? Yes, that is the expectation in 9C that we are going to discuss line by line. But before we go there, we should not get lost of the overall objective. We should still have a view of what is it that we are going to achieve at the end of this exercise. Is this only this 3? And part 5 is the auditor's recommendation of any additional tax liability. Out of my reconciliation exercise, where I see the books and I see the GSTR 9 filed by the assessee, these are all the areas where they should pay more tax on their output. 1. Second, they have availed more input tax credit, so it has to be reversed. Now, those areas I will have to comment. And any liability consequent to me observing that there is a liability because of turnover missed or because of over ITC availed, I shall have to disclose it in my recommendation in part 5. Then I will do part B, certifications. That's it. So this is how the overall GST is, GSTR 9C is structured, mainly dependent on GSTR 9. The next part, the overall reconciliation statement, the basic details which is auto-populated by the system for the first 3 parts will be there. Now the question, even before we go into the form, that I should address is, sir, I have 2 units, one in Chennai which has got 6 crore turnover, one in Bangalore, I've got a registration there, but for the Bangalore unit, there has been only 50 lakhs turnover during the year. Should I file GSTR 9C both the places? Yes, because the GSTR 9C filing is registration number wise. The overall liability, that is your limit for filing GSTR 9C, the threshold has to be calculated across locations. So if I look at across locations, Tamil Nadu turnover plus Karnataka turnover will be more than 5. So we have to file 9C. But where all we have to file 9C, wherever we have registration, the number is alive, we have to file 9C. Now there, so 2018-19, we had the number alive. 2019-20, we have surrendered it. Maybe we had more turnover, more than 5 crore, still in 2019-20 or 2021, we have surrendered the registration. We have got the cancellation also. Should I file 9C for 2018-19? Yes. GSTR 9, 9C. Even after you have filed your final return, GSTR 10, that is after cancellation of your registration, it will be still open. We have done it for one of the assessee. It is open. We are able to upload the GSTR 9 as well as 9C. Hence, so the registrations, wherever they have, even if there is no turnover, if there is a registration, the 9 and 9C shall have to be filed. It will be nil for that state, doesn't matter, but still has to be filed. And when it comes to 9, there is a possibility of saying that my turnover up to 2 crores, below 2 crores, I have an option not to file. But 9C, there is no such option. Moment your overall turnover exceeds the threshold limit, 9C must be filed. So there is no limit in terms of after 5 crores for every registration. Every registration beyond you cross 5 crores on an aggregate turnover basis, 9C must be filed. Now, are you liable under any other act? I think this is where we have to mention that data. If you are a company, Companies Act, or if you are not a company but you are having an audit under any other law like Income Tax Act or the Societies Registration Act, accordingly you may have to give that. Under which law you are liable to get audited. Now this part is very rudimentary. Once we move out of this, this is where I think the discussion area starts. The turnover that we are supposed to audited financial statements for the state with the same PAN is to be reported here. Now this number 5A, where am I supposed to derive it from? I'm going to talk about both the scenarios, whether you are the GST auditor as well as the statutory auditor, or whether you are only the GST auditor. Doesn't matter. In both the scenarios, where am I supposed to take this data from? I am supposed to take this data 5A, certainly not from the financial statement. I am assuming that this organization's presence is there in multiple states. If this organization's presence is going to be in multiple states, in that assumption, I'm going to give my view. We are supposed to have, for the audited financial statements, there has to be a state-wise, or in other words, GST registration-wise trial balance, from which a consolidated trial balance would have been prepared. And from that consolidated trial balance, we would have prepared the financial statements, on which only the audited financial statement, or from that only the auditor would have signed, and that would have been called as the audited financial statements. So we are supposed to go 2 steps backward, where from the consolidated audited financial statements, I mean not the consolidation as per AS 22. I'm talking about consolidation within the organization, various registrations under GST. Why should I worry about whether various registrations in GST? Because the various registrations in GST, we are supposed to maintain books of accounts in every registration. Hence, we cannot say, sir, we never did it for the purpose of our audit. We have to create it. It has to be there. It should have been there in the first place. So we have to take from this output, which we have in hand, we have to work backwards. I'm assuming that it is already there. In that case, we have to reach the trial balance, which is prepared GST number wise. That trial balance, which is prepared GST number wise, from that only this number has to be taken. Hence, this in cases of organizations which is having multi-state presence will never match with the P&L balance sheet that which we are going to upload. Certain. So we may have to prepare a reconciliation statement. That is, we may have to give a columnar indication of what is there. What is there in terms of, that is for this state, as well as what is the other states turnover, and hence I have taken this state's turnover in GSTR 9C5A, whereas other states turnover together stands like this, and that together, when it is totaled after eliminations, stands like this at a company level, and that is what I have uploaded. I'll repeat it for the sake of clarity. I have taken state of A, let's say Tamil Nadu state. But earlier in VAT audit, what we used to do is take the turnover of Tamil Nadu and put everything else as others. Because there ends the matter. The Tamil Nadu VAT officer is not going to be bothered much about what is the turnover of Andhra Pradesh or what is the turnover of Telangana, because it doesn't make any number. He doesn't have to do anything on that direction. But when it comes to GST, if you are going to say it is others, what are those others? Because there is a possibility that the others may not match with the other states filing also. Hence, if you are present in 5 states, we must have a 7-column trial balance. All the 5 states in 5 columns each, 6th column for elimination, 7th column for the final number. And that after elimination final number should only match with our audited accounts. In this, we have to take the respective states number. The turnover should be picked up from the trial balance only. Should I upload the trial balance? It is your prerogative. It is not made mandatory by the provisions. But if you want to have clarity, start here and maybe upload it also. You want to have clarity, but you don't want to give the clarity to the officer, don't upload. Upload only the audited financial statements, upload only your certificate with this reconciliation, enough. But imagine he will be wondering where is in that statement, that where in the financial accounts that you have uploaded, signed a copy, this number is. He will never be able to find. So obviously there is going to be a notice that is going to come in future, or they will seek information as to from where you have picked up this data. That time we still have to take this data and go. Hence, reconciled state-wise trial balance is the place from where we have to take this data. So the turnover, including exports, as per financial only is what we are going to take it, and it need not necessarily match with your P&L if you are going to have multi-state presence. The easiest scenario is I have only one state presence, I am doing it only for one state. You don't have a problem at all. This has to match with your P&L. In P&L, sir, should I take what? Should I take the total income or should I take the operating income only? My suggestion is I have opted this method with I take income. Why I take the total income? Because my non-operating income will include exempted income. That is going to be the case in most of the time. That exempted income has some GST implications, like what you would have seen yesterday in table 7, rule 42-43 reversal. If that is going to be there, then it makes much more sense for me to include that exempted turnover also for my turnover reconciliation. Hence, the total income taken for reconciliation is a much better way ahead rather than taking only the operating income. Now I have lined up all the other lines as it is in GST or 9C, but I don't want to discuss in this order, because for clarity, if you are looking at a particular line, why it is there, we should also be able to connect it to something else. Hence, I've just jumbled it the way that I can explain easily. So 5A, we have seen that. 5B, C, H and I have a connection. 5B and 5C, what are they? Unbilled revenue at the beginning of the financial year is 5B, and unbilled revenue at the end of the financial year, 5H. These two are directly connected. Now this unbilled revenue, let us take the example of a real estate project. It is running for 4 years. In those cases, what would happen? There is an unbilled revenue that you will always accumulate. This unbilled revenue, you would have paid GST on it. Because, for example, you are taking advances. You are taking advances from your prospective buyers, maybe in one installment or 2 or 3 installments during the year. On that advances, we would have paid GST. Then how to arrive at my turnover as per GST and this? Unbilled revenue at the beginning of the financial year shall have to be added, and unbilled revenue at the end of the financial year have to be reduced. Then we will be able to know what is the net revenue. This is a normal accounting adjustment which we do to arrive at the turnover as per GSTR 9. The next one is unadjusted advances at the end of the financial year is to be added, and unadjusted advances at the beginning of the financial year has to be reduced, because last year advance, I'll repeat, last year advance would have got included in the GST return, but it will not be there in my P&L turnover. But in this year, last year advance received would have been invoiced. Income would have been recognized against that and offset would have happened. But in this year end, I will again have some advances outstanding. In these cases, it has to be captured. And Whether it is a goods related dealer or whether it is a service related dealer does not matter. This reconciliation will remain the same. The tax liability only will change as per section 12 or 13 time of supply. If you are going to be a goods related person, on advances you don't have to pay GST. But if you are a service related person, as per section 13, on receipt of advances you are liable to pay GST. So that I am keeping it aside for the moment. That is beyond the discussion or the turnover reconciliation that we are discussing here. For turnover reconciliation, 2 points which have a connection, 5B and 5H, 5C and 5I should be seen in unison. Because these are the 4 lines when we populate, we should know why we are populating it. Unbilled revenue at the beginning of the financial year and unbilled revenue at the end of the financial year. When I knock it off, the net will be what is billed during the financial year, which I will be able to find. And in case of unadjusted advances, we go in the reverse. Unadjusted advances at the end of the financial, because you would have paid tax on that, has to be added, less the advances which remained unadjusted at the starting of the financial year will have to be taken off. So this is what is the relevance of these 4 lines in doing a reconciliation of gross turnover in table 5. The other lines which are there in table 5 are deemed supply under schedule 1. Before we dwell deeper into deemed supply, I want to get this 5G out of the way. Though 5G is going to come as a new technology, in table 5G of GSTR 9C is redundant. Technology wise, it can be the new name, but for GST purposes, 5G is redundant because April to June 2017 turnover is relevant only for 2017-18 financial years GSTR 9C. It doesn't have any applicability post that financial year. Hence, ignore April, this 5G, we will not be filling up any data. But very, very important, 5D. Why it is very important? Because practically also we have seen a lot of misses in this area, especially when statutory audit has happened. What is the problem that here we encountered is we are supposed to report all the deemed supply under schedule 1. What are those deemed supply? The one and the most important one which needs to be reported here is your stock transfer. I am adding the stock transfer to the P&L turnover. The P&L turnover is in 5A. I am adding my stock transfer turnover to the P&L turnover. What am I achieving? I am trying to reach my GST turnover because my GST turnover includes my stock transfer also. So I'm adding my stock transfer turnover. Is it only stock transfer turnover? Need not necessarily be only stock transfer turnover. Could be the agent turnover, meaning the supply is made to an agent, which is deemed to be a supply between agent and principal, principal and agent, para 3 of schedule 1, or any disposal of business assets on which ITC has been availed, para 1 of schedule 1. The employer-employee relationship transactions or any related party transactions are distinct person transactions as per para 2 of schedule 1. All this will line up in here. And ideally speaking, now keep in mind our trial balance discussion earlier. 5 trial balances of 5 different states, 6th line for elimination. This should ideally figure in the 6th line because Tamil Nadu turnover will contain stock transfer. So Tamil Nadu's output tax liability, it will be there. But maybe Maharashtra, it will be input tax credit. So in Maharashtra purchases, this should go off. In Tamil Nadu sales, it should go off. It should have gone off. And we have seen situations where everything has been added and reported by the statutory auditor. So where we had to see that when we report schedule 1 number, it becomes a difference. When we take the P&L number and don't report anything in deemed supply, everything matches. But if we report in deemed supply, there is a mismatch. Should we still report in deemed supply? Yes, we have to report because from a GST angle, this is a mistake which needs to be highlighted, but there is no problem. Because in P&L, we have taken a higher turnover, including the stock transfer also. So if I go and add the stock transfer one more time, in GST table 5 of GSTR 9C, it is showing a difference. That is saying that it is more, that is more than the GSTR 9, you have got the numbers reconciled as per books. Correct, but it is a mistake. Okay, will it entitle me or will it entitle me to pay more tax to the department? Certainly not, because that is where we have to give the reason for the difference. It has been wrongly considered in the P&L turnover. Though the tax has been suffered, it has been wrongly considered. So as per the statement format that which you have given, in 5D, if I populate that number, it comes out as a difference, but there is no additional revenue. That is, no additional tax to be paid by the assessee. This point has to be stated in the reason for difference, because if there is a difference, the obvious intention of the officer will be to find out if there is a difference, then there has to be a tax difference. There can be a difference without tax difference. So we'll have to substantiate that, yes, there is a difference in turnover, but this difference in turnover is not is equal to additional tax liability. We have already paid this tax. It is only a miss from a income angle. Now, from an income tax angle, was there a problem for the assessee? That is for the assessee to figure out. If you are going to be the statutory auditor, I don't think there should be a problem from the income tax angle, because what you would have done is you would have shown higher sales in your turnover and you would have shown higher purchases because you didn't eliminate it. Higher amount of turnover in the credit side and higher amount of purchases on the debit side would have naturally got knocked off. So I don't think there is any problem unless it is going to create a turnover differential. I don't see any issue. But should I report 5D? Yes. Reporting 5D gives a difference. No issues. Explain it. The tax has been paid. But there is no reason for this difference to be taxed again. That has to be told. So 5D is for this purpose. Moving ahead to the other part. Again, E, F, J. I have highlighted these three and taken it together for our discussion because all of them in a way relate to credit notes. 5E is credit notes issued after the end of the financial year but reflected in the annual return. So what has happened is in our annual return, we have taken it into consideration. And this amount is the credit note is issued after the financial year. That means for the purpose of GST, it is considered only in the subsequent, rather, I should say for the purpose of GST, it is not in the current year reporting. The reduction has not happened, but for the purpose of the income tax, that is the P&L turnover, it has already not been adjusted. So we are supposed to reduce it. Then only the reduced turnover value from the P&L, we will be able to match with the GST turnover, because in GST, we have done the adjustment. For the purpose of our annual return, we have done the adjustment. So to that extent, the turnover has got reduced. Let me give some numbers. Numerical example, I think will help. My turnover as per GST is 90 because I have considered this credit note. But for the purpose of my P&L, I have not considered this credit note. So P&L will reflect 100. So this credit note, which is issued after the end of the financial year, because as per the provisions of section 34, a credit note can be issued anytime up to September of the following financial year. So for financial year 2018-19, up to September 2019, they could have issued the credit note. And this credit note could have been considered in the GST return, but it is not considered for the purpose of our turnover. Hence, it has to be eliminated from the turnover. It can be reported in 5E. Very rare possibility, but possible. Why very rare possibility? Because the last thing that we will be doing is finalizing the accounts. So any credit note that is raised, there is a possibility that the credit note will be reported later in GST return, but will be considered in the annual accounts earlier. That is the most common thing that we will come across. But 5E provides for the reverse scenario. That is, in GST it is taken care, but not adjusted in the financial accounts of this year. Hence, we are supposed to do this elimination. 5F is trade discounts which are accounted in the financial statements, which means it has reduced my turnover in financial statement, but are not permissible under GST. Now, please understand all these discounts that which we are discussing here, or the credit notes that we are discussing here, are only from the point of view of you being the supplier. You being the recipient and getting a discount, I have a separate discussion on that. You being a supplier and giving a discount. So trade discounts which I have accounted in my audited financial statement, but are not permissible under GST, is a possibility that section 34 allows me to raise a credit note for whenever there is a reduction in the taxable value or tax value. But section 15 subsection 3 clause B says that in case of post supply discount, that is where the restriction is originating from. Section 15 subsection 3 clause B says when you want to give a post supply discount, if it is a discount given at the time of supply, 15 subsection 3 clause A allows us to do that. There is no restriction or conditions associated with that. But if it is 15 subsection 3 clause B, the conditions associated are 3. 1, it should be pre-agreed. The discount that is given should be pre-agreed. And second, it should be identified invoice-wise. And the third important one is that the other party to whom the credit note is given should reverse the ITC. Because when he received the invoice, he would have taken the ITC. He should reverse the ITC to the extent of this credit note's GST. there is a possibility that any one of the condition is not fulfilled. Mostly the first condition where it is not pre-agreed, but still I need to give a discount. For example, I am a seller of, let's say, shoe. I am the manufacturer seller. I have pushed it to my dealers. My dealers have purchased from me and they are trying to sell, but that model they are not able to sell. We didn't agree on any discounts upfront, but subsequently they said that I'm not able to push it in the market. So please give me a price reduction. Now I am giving them a credit note. This is a discount that I am giving because to push my product into the market further, but this is not a pre-agreed discount. Moment it doesn't satisfy that condition, there is no possibility of reducing my GST liability in a credit note, but I can give a credit note. That is what we would call as a financial credit note. Because you cannot even report it in GSTR1, because when you report it in GSTR1 as a credit note, it will obviously take the tax amount. There won't be any tax amount for this credit note. There cannot be any tax amount. That is the purpose of 15 subsection 3 clause B. If you are not able to satisfy this condition, I will not give this as an exclusion from the taxable value. Hence, this is a discount that which you are giving, which is not accommodatable within the provisions of 15 subsection 3 clause B, but which has to be given for the purpose of doing your business, which you have reduced from your turnover. But it will not be reduced from your GST turnover. What you would have reported already, there won't be any reduction. Hence, add it. In your book turnover, it would have been reduced. So add it, then we will be able to achieve the GST return turnover. And J is E and J. You can easily relate. Credit notes accounted for in the audited financial statement, but are not permissible under GST. Now, this is where F and J seems to be a repetition, because F is also talking about a situation where an adjustment has happened in the audited financial statements, but is not permissible under GST. J is also talking about a situation which is not permissible under GST. But I feel J is much bigger in terms of the coverage when compared to F. F talks about only trade discount, but there are other scenarios also where we would be giving a credit note. For example, return of goods after 2 years. My supplier, my customer returns the goods after 2 years. Can I give him a credit note? Yes, but the credit note should have been given before September of the following financial year. Let's say 2017-18, he has purchased from me. I should have, if he returns the goods to me, I should have given him a credit note. But that credit note should have been given before the invoice is accounted in 2017-18. Hence, I should have given the credit note before 30th of September 2018. But if he is returning it in 2018-19, that is after the September 2019, let's say he is returning it in March 2019, I have to give him a credit note. But that credit note will reduce my turnover. Yes, but it is not acceptable under GST. Hence, I feel J has a wider coverage compared to F, and both have the same implication. I don't deny that. But F is meant only for those financial credit notes arising out of trade discounts, whereas any other financial credit notes where we have to give a credit note as per our accounting need, but it is not acceptable under GST, shall have to come here, because only if we add to that extent, add back to the turnover, we'll be able to achieve the turnover as per GST. The last part of table 5 contains 5K is, I would say, is meant only for SEZ units on account of supply of goods by SEZ units to DTA units, because the SEZ units supplies to DTA units, it is technically taxable under the Customs Act. It will come under a bill of entry into the domestic tariff area. But the SEZ is part of an entity which is there in the domestic tariff area also. I have an office in Chennai, that let's say in Nungambakam next to CA Institute, and I have a unit inside the SEZ in Sholinganallur. Then both the units are two separate registrations, but they are part of the same company. When I file GSTR 9C, I have to do it for my SEZ also. But in my SEZ unit, whatever is the turnover, there will be predominantly exports, or there should be only predominantly exports, and any such clearances from them to DTA will not be there in my GST return. It will be there only in my customs levy. Hence, I have to reduce it from the turnover which I have made here, because export turnovers, I still have to disclose it in my GSTR 1 and 3B. But as an SEZ, any turnover that I have done to DTA, I don't have any scope of disclosure in my GST returns. Hence, that has to come here, is what is the reason why it has been given 5K, meant only for SEZ units. And L is turnover for the period under composition scheme. Now, this is what is called something like the Tamil cinema version, where hyper positivity in the 90s and late 80s, 90s, we will have in one song the hero becoming the richest person. If of that sort of anything has happened, then I think 5L we will be filling it up. That is, we are looking at a situation where in 2018-19 a person started as a composition taxable person, and then what he does is, from being a composition taxable person, he has become a normal taxable person because his turnover crossing the limit, and not just that, he has crossed 5 crores also. So who thought that I'll be lesser than 1.5, crossed 1.5, became a normal taxable person, and crossed 5 crores also, became liable to file GST or 9C. Then during the year, he would have had a turnover under the composition scheme, which we wouldn't have reported in 9, because what we will report in 9 is only his turnover for the period for which he was a normal taxpayer. So we will have to eliminate that turnover here. Very, very rare. I would say 99.99% there is no possibility. At least SE said there is a possibility. K, L is quite rare. And M, this is the one which I believe there was already a question which was posted. I told you, even before the session started, I had the question in the Q&A. Relevant for discussion of that question also. Section 15 has got a subsection called Section 15 subsection 5. And based upon the powers given under 15 subsection 5, in Rule 32, Subrule 1, 2, 3, 4, and 5, 5 different type of businesses, department has notified special methods of valuation. 5 different types of businesses, they have notified special methods of valuation. The businesses being foreign exchange business, the airline ticketing business, life insurance business, and then the life insurance policy, that is, and then the second-hand goods, used goods dealership business. Used goods dealership business itself, where there is a repossession by a financial institution. So these put together are the special methods of valuation. Now, why am I discussing this? This is one part, special methods of valuation. The second part is, even in our own books, there is a possibility of reimbursements. Reimbursements which are pure agency in nature. Pure agency is discussed in Rule 33. It talks about a situation where we are acting only as an agent for our client, doing our service also, plus incurring some reimbursements where we bill in our invoice the reimbursements as well as our value and collect from them the tax only on our service value. I'll give an example. Maybe we paid ROC fee or some fee which the client has to pay, plus our audit or our service fee, 5,000 rupees plus GST. Now the 30,000 rupees of fee that is paid plus 5,000 rupees our fee, GST shall have to be charged only on 5,000. Because the 30,000 is paid on behalf of them and the benefit is going to be going only to them. So this 5,000, that which we are going to show as our income, that 5,000 only we are going to charge GST. But suppose we have a practice of accounting this 35,000 as our income, then the adjustment to the extent of what we have done as a pure agent shall have to be reduced here. That is why this plus or minus is there. It could go either way. In the example that I took, it is a minus. Now look at the same situation, a slightly different example. My fees is 5,000. I am claiming a reimbursement from the client for, let's say, conveyance for 1,000 rupees or a stay for 1,000 rupees, which I have used. It is not incurred for him and the beneficiary is him, which I have incurred for the purpose of rendering the service. Then it doesn't come under Rule 33 as pure agent. It shall form part of the taxable value. In that case, we should have already paid GST on 6,000 only. So that is something which can get added if it is not added already. What we thought as reimbursements are not even taxed. GST or 9 also is filed like that. But the turnover contains this. It has to be added here. And the reason I took Rule 32 into contention for discussion is, in those assessees cases, that is special method of valuation cases, especially the second-hand goods dealer, that is the used goods dealer. Though the word second-hand goods is used in the rules, they are not only meaning second-hand, it could be multiple hands passed also. Still, it is used goods. Any used goods dealer who is procuring those such used goods, let's say I am a used car dealer. I think that is a common example we will use always. I'm a used car dealer. I'm procuring a car for 3 lakhs from a person who is unregistered. So there is not going to be any ITC that I'm going to take on that. That 3 lakhs worth of car, I'm able to put in some minor repairs here and there, and then I'm ready to sell it at 3,50,000. In this case, Rule 32 sub Rule 5 gives me an opportunity to go for an option of paying GST only on 50,000. who would go that let that opportunity go? Everybody would grab that opportunity as a dealer in used goods. So I will say I will pay GST only on 50,000. Yes. Now in this case, two questions will arise. Is this 50,000 to be considered for the overall 5 crore calculation? I mean, the limit within which if you fall, or rather the limit which you cross, you must do GSTR 9C, the 5 crore limit that we discussed. Should we take 3 lakhs plus 50,000, which is my collection, or should we take only this 50,000 for calculating this 5 crore limit? It is clearly said that your taxable value will only be this 50,000. And that is why if you see in GSTR 1, when we are filing our monthly returns, there are 3 columns when we are filing for our output tax liability. The first column will be the taxable value. The second one will be our tax. And the third one will be the invoice value. Had the department thought that invoice value will always be equal to taxable value plus tax value, they wouldn't have made the invoice value field as a keying in field. It is an input field even today. The reason is, in this invoice, which the car person selling second-hand dealer of car is going to sell, he will raise an invoice for 3,50,000 rupees plus GST on 5,000. So how will it look like? He will say, sir, 3 lakhs reimbursement, 50,000 taxable value, GST on 50,000, I will say 9,000, or rather, 9,000 as my GST liability. This is how, and this is what I will show in my invoice. So my invoice value will be 3,59,000. But my GST taxable value will be 50. My tax will be 9,000. So which one should I consider? Should I consider 3,50,000 as my turnover, or should I consider 50,000 as my turnover? 50,000 only. Suppose the second question is, if you have accounted in your books of accounts 3,50,000, because that is how you are supposed to do the accounting. You will show 3 lakh as purchase, 3,50,000 as your sale value. You are right. In that case, how will you reach 50,000? On which only you filed your GSTR 9, on which only you paid the tax? Remove that 3 lakhs using this 5M. Adjustments in turnover, which is advocated under section 15. 15 has delegated this by way of 2 rules, rule 32 and 33. If you are falling under that, please remove this here. That amount of turnover on which you were allowed not to pay GST, which is not considered as taxable turnover, remove it here, negative, minus. So that is why this 5M is there. And 5N is adjustments in turnover due to Forex fluctuations. Our foreign exchange fluctuation, like I discussed earlier, should I take total income when we are going at P&L? Yes, because your other income will contain Forex fluctuation also. That has to be separately shown here, as the case may be. The Forex fluctuation can be a positive or a negative fluctuation. As the case may be, it has to be reported here. And then the favorite area for us, anything other than whatever is given from above. There is a possibility, yes. If anything can come here, but I'll give you a common example which can come here. Sale of fixed asset. Sale of my fixed asset. How to determine it while doing an audit? Please go through the fixed asset register. In case of a company, go through the fixed asset schedule. There will obviously be deletions, or in other words, what is that? It is not say disposal, retirement. Retirement of assets. Assets retired. This will be there. Now look at it in the fixed asset schedule of the balance sheet. Now for those, when they are disposed of, for example, an asset is disposed. Let's look at the example from a tax audit perspective. A person who is subject to tax audit only. In that person's case, there are 5 assets in the block. He would have sold 1 asset. We would have never shown any income in the income tax P&L. Why? Because the whole value of the block is still there and the assets are also still there. So there is no profit or loss. There is no short-term capital gain there. But for the purpose of GST, the disposal of the capital asset, you would have raised an invoice. On that invoice, you would have paid GST. That will not be there in your P&L turnover. The income as per the Income Tax Act, that turnover, it will not be there. Then what am I supposed to do? In those cases, we are supposed to come down and give it as an any other adjustment. In 5O, it is on account of stock transfer. It is on account of capital goods supply, sale, where I have got a GST liability. I have got a turnover under GST, but it is not a turnover under income tax. Show it under 5O. It is not a turnover under Companies Act, because even under a Companies Act scenario where you are selling, you are disposing of your asset, only the profit or loss on disposal will come to your P&L, not the gross value. The selling price will not come to your P&L. Profit or loss will only come. But when you are disposing of an asset, we will raise a GST invoice on the basic value. When I am doing that on the basic, that is the selling price, on that value only I am going to pay GST. For example, an asset worth 1 crore in the books, WDV, is being sold for 1.2 crores. 20 lakhs will hit my P&L, but is that 20 lakhs the taxable value under GST? Certainly not. When I am selling it for 1.2 crores, the taxable value under GST is obviously 1.2. But what would have been shown in the P&L is 20. So we may have to add 1 crore here. That will come in 5O. So these are the common situations where 5O will have to be used. But using 5O does not mean that don't document anything for it. Please document it, because when we say that it is any other reason why there is a difference, obviously there will be a question. Hence, my suggestion is, if you put it under 5O, better, there is a reason explanation column below that. Write in that reason explanation column that the amount reported in 5O is because of A, B, C, D. These are the reasons, because 3 years later when there is a question, we ourselves will not remember where the working paper is. Even if we remember, we will not be able to get the correct version of the file. And even if that is happening, that same article clerk or same paid assistant will not be there to explain. So the best thing is put everything here only. So by reading it, if we are able to understand, we will be able to manage. Hence, whatever we reported in 5O rather, what you reported in 5O, please explain the differences also. Though there is no need for us to explain, please put it there. There is nothing wrong in that. We will be able to identify at a later point of time why this difference arose. Hence, these last three can go in either of the directions. It can go plus or minus. Now, one more clarification which I wanted to give, because we had a discussion on this point in another situation in the Institute forum only, where somebody was saying that when tax audit is going to be there, when GST audit is going to be there. Now, it is a tricky situation. When tax audit is there, that is income tax audit, I'm not going much into that, but the 5 crore limit of 2018-19, let's take an example. I took a situation where I don't have tax audit under income tax, but I'll still be subjected to GST audit. Now, how is it possible? Very much possible. My renting turnover, I am a person who has got 5 commercial complexes. I've given it on rent on Mount Road in Chennai. The per month rent is about 50 lakhs. So in a year, my total turnover is 6 crore. Am I subjected to tax audit? Certainly not. I'm disclosing everything under the income from house property. I'm not disclosing under PGBP. If I go under income from house property, now imagine, in that case, what is going to happen? I will not have a tax audit. Hence, there is a possibility that a person doesn't have a tax audit under income tax, but he is liable for GST audit. Because from a GST audit perspective, renting is taxable. I have a business, the turnover of the business is lesser than 5 crores. I've got income from, let's say, other sources, maybe like renting of land, or even renting of building and land pertinent thereto, as per section 22's expectation. These two are there. Together it is crossing 5 crores. GST audit is compulsory. I may not have income tax audit. Hence, it is not a thumb rule that if there is an income tax audit, GST audit is there. Yes, I will agree to that point. It is something like this, no? All contracts are agreements, but all agreements need not be contracts. Same way, when there is an income tax audit certainty, probably because of turnover, then you will have to come to GST audit certain. But even when there is no income tax audit requirement, GST audit can arise for that person. The example that I gave you would, I think, suffice to substantiate that this is possible. Okay, now moving to the next part, which is table 6, where we are supposed to give the reasons. What are the reasons at which we are going to give here? As I said earlier, if there is going to be a difference, we have to substantiate the difference. 5O situation, where I told you voluntarily you can come forward and give your explanations. Yes, you can. If there is going to be a genuine difference, I do not know what it is, cannot be the answer. So we have to find out why it is there. And very, very important part of that identification is, will it result in a tax liability? Like I said earlier, 5D, the stock transfer turnover was also considered by the statutory auditor as turnover of the company. it will arise as a difference. But in reason 1, you can type that stock transfer has been wrongly considered, but the stock transfer has already suffered GST. So it is only a mistake in the books. There is no further tax liability. Please use this wordings or use a different wording to convey to the officer that there is a difference, but the difference does not make me liable to pay additional tax. That is when the reason substantiated will not result in additional tax liability. If you just explain the reason, not telling about the impact of that in the tax liability, then there is bound to be a notice, either by the system automatically or by the officer saying that why don't you pay tax on the difference. You have to substantiate that there is a difference. There are two kinds of differences. Differences giving rise to tax liability, differences giving not rise to a tax liability. So we have to classify that also and mention it here. Turnover difference we have to substantiate and also tell our view as to whether it is resulting in a tax liability or not. That is why this table will have to be effectively used. Now moving to the next aspect, that is the reconciliation of the taxable turnover. Next part. The first part, what we reconciled was the overall turnover. Now, whatever is the outcome from that discussion, that is up to 5O, then we will have 5P. From that, the turnovers on which we are not liable to pay any tax, those will be eliminated. That is, either it could be a zero rated, exempted, nil rated. These will have to be eliminated. You have to be very careful in this. Why am I saying careful? Because system doesn't have any control. Why? How? What is the problem? In one of the GSTR 9s, I saw that assessee has reported it as zero rated turnover in GSTR 9, the corresponding table of table 5, where he has reported that it is zero rated turnover. With LUT, thus there is no liability to pay tax. But in the GSTR 9C, the auditor has populated it against 7B, that is exempted turnover. If the auditor says exempted, assessee is claiming it as zero rated, department will believe the auditor, give a show cause notice to the assessee saying that, sir, why don't you reverse your input tax credit to the extent of this turnover? System doesn't do the check. System will just take your 9C standalone. 9 is standalone. Hence, when you fill up this data, be very careful because this will never figure in our tax reconciliation because the turnover that which we are discussing here, 7B to 7F, are only having an impact in turnover. They don't have an impact in tax. Hence, when you are populating from there to here, please ensure it is getting populated properly. Exempted, nil rated, non-GST, no supply, everything in one line. Zero rated has to be reported separately. So SEs that supplies export of goods and services shall come in 7C only without payment of IGST. If it had been with payment of IGST, it would have already figured in the overall one. And D is supplies on which, that is my outward supplies, on which my recipient is liable to pay under reverse charge. So this is not my inward reverse charge. This is my outward taxable supply on which I am not liable to pay reverse charge. The recipient is liable to pay reverse charge. Then in those cases, I will report it in 7D. It is my turnover only. Once these three are removed from the adjusted turnover from 5P, we will have the turnover to be compared with GSTR 9. Which turnover of GSTR 9? Table 4. What we saw in table 4N, that will be compared here and the difference will come out. Generally on these turnovers also, there is a possibility of difference. You please report it. And that difference which is coming should not result in additional tax liability. That is a general expectation. It should not result in additional tax liability. But there is a possibility that in case of zero rated supplies, there is an amount coming on which we are liable to pay. Yes, there is a possibility. But generally, this will not result in additional tax liability. The reason for difference also shall have to be given in table 8. So that is how we'll be able to finish our turnover related disclosures and turnover related reconciliation. Once this is done, we are supposed to give the output turnover related tax liability. ITC, we are postponing it for the moment. We are discussing the reconciliation of the tax paid. The tax paid reconciliation has to be given in table 9. And this table 9 is the table 9 of GSTR 9, where we are disclosing what is the tax payable. The same shall have to come here, but here we are supposed to disclose it rate wise. And inside the rates also, what is the liability arising on normal supply, that is normal charge vis-a-vis the reverse charge supply. Both will have to be segregated. 5% for my normal supply, 5% for my reverse charge supply, then 5% normal supply, 5% RCM supply will have to be split and shown. And this is what is the taxable value on tax value, that which we are disclosing here. we will be able to overall reconcile with the tax liability. So what is disclosed in 9, rate-wise split will have to come here. And then we are supposed to say that this is the amount that is payable and what is the tax that is paid. What we are populating here rate-wise will get populated in 9P, and then in 9Q, the amount from GSTR 9 will get auto-populated, differences will arise. If there is a difference that is positive, it means that we are still liable to pay taxes to this extent. If the difference is going to be negative, it is to say that we have paid more taxes. If this amount is going to be negative, you have to be doubly careful because we are certifying that the assessee has paid excess tax. What is the recourse? It has been clarified in circular number 125 also that in these cases, the assessee is entitled to claim a refund. And since we are discussing about 2018-19, the 2018-19 financial year, as of today, when I am discussing, still the time limit is available for them to go for a refund if they had paid excess tax, because the 2 years time limit has not expired. In those cases, they are entitled to go for a refund. That refund, the main document substantiating the stand that they have paid taxes in excess will be this, where we have given the 9C in 9R, we have told in 9C's table 9R that they have paid excess tax. Hence, be very clear in terms of reporting it here. Once or twice check it and then only it say that they have paid an excess tax. If the numbers are going to work out in that way, report it. This can form the basis for them claiming a refund of tax paid in excess. There is going to be a shortfall. Obviously, it is going to become a recommendation by us in the part 5 for the assessee to pay the differential tax. So this is where we sum up our tax, the outward tax liability, which arises on my outward supply, the tax liability further split into percentage, and then what has been paid compared. Now I have my turnover reconciled, I have my taxes on my output reconciled. This is what I have done. Now what we are going to venture is into the ITC part. But what I'll do now is I'll take 1 or 2 questions, and then maybe at 6:30 exactly we'll break for about 5 minutes. I'm assuring you that there is going to be a break. That is what I want to do first. So we have another 8 minutes to go, because before I start ITC, we will discuss that. We'll take few questions and then we'll come back to ITC after the break.
Shankar, shall I pose the questions which have come?
Yes, sir, please.
Okay, if you can stop sharing the screen, I will share mine.
Yeah, I'm doing it. Yes, I've done that.
Yeah.
I'll be able to see in the Q&A box, right?
Yeah. No,
Yeah.
you'll be able to see on the screen.
Screen itself. Okay.
Yes, I think 3 I have taken the one which has come in the beginning. If you have covered, you can tell that.
Okay. Yeah, 32.5 I have covered that.
Okay.
RCM. I will cover it towards the end of my presentation. So RCM I'm postponing for now.
Okay. Okay.
GTA RCM, I think that is the same question.
Okay.
Yes, same question. Yes.
This one?
Yeah, 12C. Again, it is ITC related, sir, which we are going to take.
Okay.
ITC is still not discussed.
Okay.
Should we declare the value of purchases compulsorily GSTR 4? Sir, GSTR 4 is composition taxpayer annual return. So yes, you are supposed to, if the return itself is postponed and made as yearly return from 22nd April 2019, the notification was given. The Excel has been released a couple of weeks back. The purchase data that is given there, yes, we'll have to disclose. Also, can we increase the value of sale in GSTR 4 compared to CMP 08 and pay the tax liability? Yes, it is like any other normal tax payment, sir. We can, but interest will certainly arise. A company is having dispute before NCLT on management and no audited financial statements are available. The company is carrying business and filing GST returns. In such a case, how to conduct GST audit and what is to be uploaded in the absence of audited financial statements? If you are liable for audit under any other law, the audit should have happened under that law. If it is, you are liable, but you have not done the audit there, but you want to file it under GST audit, then my suggestion is the assertion that I discussed first, if you remember 35 subsection 5, where I told you read with 2 subsection 13, you are supposed to do the verification and analysis also. That is the examination and verification and reconciliation statement. All the 3 will have to be done by you. So you have to proclaim that I am the statutory auditor. But is there an option available in the GSTR 9C? No. So what we need to do is we have to take that and maybe give a letter in the in writing to the officer saying, though I have mentioned that the audited financial statements are there, that is, I am the statutory auditor, but it is not an audited financial statement. We are filing GSTR 9C only. But the problem will be the credibility of that statement, the balance sheet and P&L which we are giving. Tomorrow, if the numbers as per Companies Act changes, there can be a question from the department. Hence, I would suggest to complete the audit under any other law, carry that here, because this is only a, I would say, underlying audit. It is not a primary audit. GST audit is not a front-facing audit. At least income tax audit you could have completed. Then maybe you can come to GST audit. That is my suggestion. 8th question. Is there any limit for undertaking GST audit company, as we are having limited case of tax audits? No, sir. Nothing from the institute side so far.
As of now. Yes.
See, is smiling. So as of now, it is not there. I will quote it that way.
Yeah, same question.
Same question.
Yeah.
If advance amount is reflected in 26 AS, but assessee has not issued invoice in the current year, then whether advance to be considered in computing aggregate, sir. 26 AS and is not material, sir. Advance, if you are going to calculate, that is, you are saying aggregate turnover. In case of an aggregate turnover, I wouldn't include it, because if it is an advance, it is not your supply. You are supposed to take only supplies for the purpose of aggregate turnover. But if you are asking whether it is a turnover on which I am liable to pay GST, yes. And section 13, subsection 2 very clearly tells as to when you will become liable. It is the date of credit in your bank account or the date of, say, entry in the books of accounts, whichever is earlier. If 26 days they have deducted, fine, it is in their books. But have you received the money in your books? If yes, then that will proceed. So the liability part, yes, based upon what you account in the books of accounts, liability will arise. But should I consider that advance for my aggregate turnover? Certainly not. Aggregate turnover is supplies. Advance is not supply. Advance is time of supply, makes you pay the tax earlier. 11th question. An commission agent who deals in agricultural goods has turnover under GST exceeds 2 crore. But under income tax, only his commission is shown as income and the audit is not done under income tax. How can we issue 9C since no audit is done anywhere? That is where I told you, in those cases when there is no audit under any other law, you'll have to assume the responsibility of audit under GST law. And don't give a letter to the officer saying there is no other liability. Hence, I have put myself as a statutory auditor. But there is no liability to get audit under any other law. I am liable only under GST law. But the earlier case, I suggested them to do the income tax audit because there is a probability of dispute. They are still in the dispute. But in your case, there is clear evidence that you are not liable there, but you are becoming liable here. Then the audit itself is to be conducted under GST. The next question, 12. For government contracts, TDS has been deducted on the total value inclusive of GST. How the turnover difference should be disclosed in 9 and 9C. TDS has been deducted on the total value. Okay. Turnover should be disclosed in 9 and 9C. Sir, once you have raised the invoice only, they would have done the TDS. That is what is my assumption. So the moment you raise the invoice, it becomes part of your turnover. So there is no problem in reconciling your turnover.
No. When you're putting, say, 1 lakh of rupees invoice and 18% as the GST amount,
okay,
the TDS should have been deducted on only 1 lakh, which is the actual turnover. Correct. What here this got deducted on 1,18,000.
Oh.
So that reverse working, if you do, it will look like there is a problem.
Understood. It will be a problem in income tax. In GST's perspective, I don't see it as an issue at all. You disclose only your income part, okay, and go with the reconciliation. I don't think it will affect. Even if it is a TDS under GST. Let me put it like this, section 51 TDS, where they are supposed to do a TDS on government departments. When you give them a bill, they will do a TDS and give it to you. In those cases also, only if you give an invoice, it is going to happen. So I don't think it will result in a difference in GST turnover. Income tax, yes, you'll have a problem substantiating. Why did they deduct? If you do that by 2%, divided by 2%, you will get a higher amount as turnover. You can always have a reconciliation for it. But in GST, will it matter? I don't think so. Next question. Input received interstate purchase in IGST but wrongly taken in CGST as GST. Can I rectify it in the annual return? I'm rectified in 3B subsequent year before September. Option.
Okay, no. Two options. One you rectified before September, one you do not rectify before September.
Not rectify. Okay, that is the question. I'm in rectifying in the subsequent year return or not rectified before September. Okay. ITC though is reserved later. It's a prelude to the ITC discussion. No ITC can be availed in GSTR 9 and no rectification of ITC can be done in GSTR 9. Only substantiation of the ITC taken as per 3B has to be given in GSTR 9. and that only will be compared with your books. So 9 will become the basis. In 9, what are you entitled to do is whatever credit that you have taken in 3B, you have to substantiate as to in what reason you have taken, whether it is input capital goods or input services, or it is imports or RCM or your normal B2B purchases. Hence, additional ITC taken or reclassification of heads not possible in 9. Second, if it is nothing is done before September, see the correction of ITC will be done in your 3B only, if at all you are identifying it and doing it. In 9, nothing can be done. So this will not affect my 9 or 9C also, availing on the wrong head. But in 9, what it can do is, if as an auditor you find out that it has been wrongly availed, in table 7, you will have to prescribe reversal. Because to that extent, the credit is not lying in CGST, SGST, it is lying in IGST or vice versa. So you'll have to tell this head that they have taken so much ITC, but it is not supported by the document. So reversal is warranted. You have to tell that. In the 9C, assessee himself does it in 9, good. Assessee doesn't do it in 9, in 9C you'll have to tell that as a reversal.
Work in progress.
Work in progress. Work in progress with the percentage profit. While in GSTR1 there will be turnover to the extent of GST invoices. In Form 9C, reasons for the differences may be reported in these 4 years for this project. Is this method of accounting correct? Yes, sir. This is what is that unaccrued revenue that we discussed, unearned revenue, what we discussed earlier, where we go by the contract method of completion. Basis we might be doing the P&L or the calculations. The differences are very much allowed. We can show it as other differences also, even if we are not going to have a opening WIP as a closing WIP. But any billing during the year shall have to be taken. Now I'll tell a unique situation. Builder started collecting advances, but no revenue was recognized in the P&L. Because if he feels that as per accounting standards, there is no need to recognize any income. He has only received advances. The work has not progressed to that extent where he can recognize in the P&L. So the P&L turnover was 0. We added all these advances and we arrived at the GST turnover. So that is how it should be handled. Yes, you can do the adjustments in the respective columns. If nothing is working for you, 5O will be your place. One trust rented its property for commercial use and used such rent to do charitable activities. Can I avail full ITC on the building which I let out as specific for services, or I will be eligible for proportion basis in general? Okay, you are talking about your outward being exempted. Yes. Okay, for the building you are talking about ITC, I would suggest you to please look at 17 subsection 5 clause C and D relating to the immovable property related ITC, specifically not allowed. So please make note of that. That ineligibility is not there. Then you are entitled to take ITC. But as you have rightly said, since it is proportionate, one part of your output is exempted because notification 9/2017 of IGST, which contains the exemption notification, it says that any services rendered by a charitable organization, which are in the nature covered under section 12A of the Income Tax Act, you are exempted from paying GST. It is not taxable. So since it is exempted, that will become your exempted turnover, and this will become your taxable turnover, the renting of immovable property. So proportionately only you can avail ITC. It will arise, rule 42. But there, if you can substantiate that it is none of it is used for this purpose, the T1, T2, T3, T4, if you can put it under T4 under rule 42, you will be able to take the full input tax credit. See whether these conditions, these provisions that I discussed, you are able to satisfy. The next question is, when credit note is raised only for difference in rate of tax amount, how to report it in GSTR1? There are two ways in which we generally ask people to report it, sir. One, the taxable value will be reported to the extent of tax that has to come. But the invoice value will only be, that is the note amount, will only be the tax amount. For example, I want 18 rupees, 28 rupees was levied as tax on a 100 rupee transaction, whereas it should be only 18 rupees. Now I want a credit note for 10 rupees, but the 10 rupees should be tax only. Then you give an taxable amount in such a way that the tax comes as 10. And then in the note value, you put the tax amount only as the note value. I told you earlier itself that there are 3 columns, that is taxable value, tax value, and invoice value. Likewise, in case of a note, taxable value, tax value, and note value. Note value will be equal to tax value, but taxable value will be there only for the purpose of GST returns, GSTR1. It will never come in your calculations. This is one method. The best method would be to raise a credit note for the whole of the invoice and raise another invoice for the revised value. That will be the best method. But in some of the cases, assessees came back saying, sir, how will I convince my customer to accept the new invoice? because he has already accounted the old invoice. He wants only a credit note. In those cases, I think the first method, what I suggested, will only work. Yeah, I think we will stop here, take a 5-minute break, and then I think we will take the
So it is
further section. And then
6:40 will resume back.
yes, sir. Okay.
But am I audible?
Yeah, you're audible, Abhishek. You're audible. Abhishek, if you may
Yeah,
make
dear
announcements.
members. Yes,
Yeah.
yes, Chair. Dear members, I will share a few announcements since you must be returning from your comfort break. We will share a few announcements of our upcoming programs. Many of you may have already registered or you may already be aware. If not, please do join us for these programs. On 14th of August, we have a peer review program where we have our Central Council member, CCM Daya Nivas Sharma from Hyderabad will be joining us along with the past President Amarjit Chopra. Both of them will be addressing. This is a free program. This is a free program. This is scheduled for 14th of August. On 15th of August, on Independence Day, we will have the flag hoisting ceremony along with a discussion by eminent past chairman of our SIRC. 4 past chairmen will be coming and the session will be moderated by CA Pattabiram. I'm sure it will be an excellent session. It will be on the CA profession going forward and the impact of the economy on the CA profession. It's a very, very important topic and important for us to prepare. This is also going to be a free program. So 14th of August and 15th of August, both programs are going to be free programs. Then on 20th of August, we have a code of ethics. Code of ethics, you all know code of ethics is now a mandatory requirement, by ICAI. So we have organized another program where we have a past president, CAK Raghu. CAK Raghu will be joining us for this program. I'm sure this will be an excellent program. So I request you all to please join for the same. On 26th of August, we have CA Kapil Goyal. Kapil Goyal will be joining us. Originally scheduled on 22nd. This has been pushed back due to some timing constraints. This has been pushed back to 26th of August. So people who have registered, we will automatically move you. Anyone who has yet to register, now when you register, it will come for 26th of August. 26th of August, CA Kapil Goyal will be addressing us. We are also working on an information technology related program. It's going to be a very, very important program for us going forward, especially given COVID. Information technology has come to the forefront. So there are a lot of opportunities, a lot of challenges, and a lot of new things which are coming up because of this that is going to impact our CA course and our CA chartered accountants in practice also. Normally, we used to think the technology means one arm distance we will keep. But today, keeping that one arm distance means you can distance yourself itself away from opportunities. So today's opportunities are coming that way. So we thought it right. And chairman being a technology person, he is very insistent and he did a very successful program last year in a similar mold. So we have thought we will do it in a virtual way so that more members can attend. So this the date's not yet finalized, but we will be intimating you. And of course, on 31st of August, as I said in the opening address, that we will be having a program on networking, mergers, and other guidelines for firms who want to join together, partners who want to join together or take over, etc. This will have huge benefits for empanelment and getting new clients. So this program is scheduled on 31st of August, where we have Kozima Amajwala from Mumbai. He'll be addressing. This is on 31st of August. So that's the list of the programs that we have lined up for you. Many more interesting programs we are in discussion, and we hope to announce the dates. Probably in September it will come. So request you all to please join us. You have been coming in such large numbers, and we request you to please continue joining us in such large numbers. So now over to our eminent speaker of the day, C.A. Shankar Narayanan, to continue his session.
Yeah, Shankar, you will take the questions or you want to cover the
I'll
PPT?
finish the presentation and then we'll come to the questions.
Great. I'll just give you the rights then. Just give me a moment.
Yeah.
Rights transfer.
Yeah. Noted. Okay. I hope my screen is visible.
Yes.
Okay, fine. So post break, as I said, the input tax credit will have a lot of traction towards this discussion because the ITC reconciliation, I had it as a real challenge, especially for 2018-19 and 19-20. I can imagine now itself that how difficult it is going to be. Because in 17-18, when we were finalizing the accounts, we would have thought that, okay, GST reconciliation we will do later, and 17-18 accounts have been signed. 18-19 also, that reconciliation had happened or had not happened, then it is going to be a real task because from 1920 onwards, matching with 2A has become part of the monthly compliance. Hence, we have to define the opening balance properly, which would be 1819. So what is the reconciliation that is expected? We'll go through that, and then I'll tell you the pitfalls that we will have to be careful about. Table 12 discusses about the reconciliation between the books and the GSTR 9 disclosed ITC. What all are the components of this is, now please refer back to my trial balance, which I told you, which is applicable for this registration. From that, we are supposed to take the ITC availed during the period. It is not the ITC closing balance as on 31st of March. It is the ITC availed during the period. Now, why I'm stressing on the word ITC availed during the period is, many of the people have either taken the closing balance or they have taken the debit of the ledger. For example, assessee is maintaining a ledger where the debit is there and the credit is going to be the transfer entry, or the credit in the ITC ledger is going to be the entry to post it to the tax liability. The total of the debit they are taking, but which is wrong, because some of the times they would have posted the entry there and they would have reversed it subsequently because of a credit note. Then net of it should have only been taken. Sir, how will I then identify it? The best method will be to identify the credit availed as per the books, documents wise. Invoice by invoice we are supposed to have. Later on, I will also take you through the list of registers that we are supposed to maintain, wherein input tax register is a major document that must be maintained. So the ITC that is availed has to be substantiated with the details that are required in the input tax credit register, though they are not defined what are all the details that is required, but that as a document is mandatory. Hence, every credit that you say that we have availed during this year as per books should be supported by an entry of a document, not an accounting entry, whether it is a journal entry or a purchase entry. Leave all that aside. It should be supported by a document. Which document? Rule 36, sub rule 1. As per that, any one of the 5 documents should be there. It could be a tax invoice, it could be a debit note, it could be a bill of entry, it could be an ISD invoice, or it could be a self invoice, which I am raising on myself for paying RCM. Any one of the documents should be there. Then only this is allowed. So that amount, if we are not able to arrive at it, then we'll have a problem in the 12F. That is why I put plus or minus there. It can arise. But if you are able to have substantiation of what are all the invoices for which I have availed ITC, 12A shall contain that. No, I will just go by the books value, then we will see what is the difference. Then you have to go only by what is availed in the books. So this availed in the books will not be there in the trial balance, because the trial balance will only contain 31st of March 2019's balance. Availed in the books of accounts is totally availed during the year minus totally utilized during the year net. Net is what we are having, but I want only the totally availed during the year. Hence, data finding out for this itself is going to be a task. And then what are we supposed to do is, in books, this is what is the breakup that I have. Now, the ITC, which is booked in the earlier financial year, but claimed in the current financial year. In 1718, an invoice, let's say we have booked it, but the credit was availed in the subsequent year. Possible, because for closing our books, we would have made a provision, or for closing our books, we would have accounted it. But physical receipt or the credit would have been taken in GST only in, let's say, April 2018 or May 2018. Those invoices will have to be found out, and those invoices we'll have to add it back, which means these invoices are actually not there in your 1819 trial balance itself, not just the trial balance, 1819 accounts itself, it is not there. So these are the invoices which you are going to say that I am picking it up from 2017-18. It was accounted in my books in 2017-18, but the credit is availed only in 2018-19 in GST. That has to be added. And then ITC that is booked in the current financial year. So the entry in the financial records have come in the current year, 2018-19, but the credit I'm not availing now. I'm availing it only 19-20 financial year. This will be a very good starting point for 19-20, because what we disclose in 12C will become 12B in 19-20. But check whether you have done the same in 2017-18. I think many of us wouldn't have done, because the department also has empowered us in saying for the financial year 2017-18 and 18-19, these 2 financial years only, the reporting in table B and C are not mandatory. So what they have told us, table B and C in this, 12B and 12C lines are not mandatory, it is optional. All of us have exercised this option in 17-18. Most of us would have exercised. If you have not exercised, you are little safe, because you can populate your 12B with your 2017-18 data. But it is not there. Then can I exercise the option in 18-19 also? Yes, please, you can. But for 19-20, will you be able to define your opening balance? Because if you have to incur all this effort in 1920, you have to work back for 2 years. But at least if you are able to do it for 1819, you have to work back only for 9 months or 1 year for 1718 only. Then you will have a set data in terms of invoice-wise breakup for 1819. Then we can progress to 1920. Hence, my suggestion is, though it has been given by the department as an option, do not take that option. That option will spoil our reconciliation. Do not take that option. Do this reconciliation. What is availed in the current year but booked in the earlier year? What is booked in the current year, availed in the subsequent year? Add the first one, reduce the second one. We will get the adjusted ITC as per books. Compare it with GSTR 9. In GSTR 9, whatever you have, that will automatically flow here. Now there is going to be a difference. Then what will be the answer? If the difference is going to be positive, that is, in your books there are more credit, but in your GSTR 9 there is lesser credit. Directly, to me, it means that it is a write-off, because you are carrying unnecessary input tax credit in your P&L, rather in your current asset. It has to roll down to P&L. Your current asset is having, let's say, 2 crores, but you are claimed as per 9 current asset, by which I mean not the one at the end of the financial year. I am still talking about the ITC availed during the year. Availed during the year, as per the books, comes to 2 crores, but availed during the year, after adjustments, that is plus or minus, comes to say 1,80,000. But as per GSTR 9, it is still 1,60,000 only. Sorry, 1 crore and 60 only. Then what happens? The difference of 20 lakhs seems to be over availed in the books. If it is over availed in the books, what does it come down to? It will result in increase in the closing balance. Then it means what? It is a current asset which is carried forward unnecessarily, which doesn't have any corresponding evidence in the credit ledger. Then the 20 lakhs should roll down to P&L. This is going to be a P&L impact if there is a positive difference. This is the common possibility that I have seen. Negative number. Then what can happen is, it is a strange scenario where if this negative number is there, in GST we are not going to have a problem. But we can have a problem from income tax angle. It means in GST we have availed the credit, but in books the credit is not there. In books the credit is not there. In GST we have availed it. Do we have a document-wise breakup for it? If the answer is yes, then the accounting needs to be revisited. There is some problem in the accounting. And as I said, in case of a double entry following person, this may not be an issue, because you cannot avail ITC as well as claim it as expense. But it is not the case. The person is only doing for the purpose of income tax. There is no balance sheet. There is only a P&L in those cases. Then there is a possibility that this negative can arise, and this negative would mean you have availed more in your GST returns than what is available in the books. It could be because of previous year, next year, then it should have already been taken care in B and C. So that options being exhausted, I don't think we have an answer to this negative. This negative would mean your accounting is a problem, which can also mean in income tax you have claimed the ITC as expense also and claimed it as ITC in GST. That is the answer that I get, or that is the inference that I get when I look at a negative number. Hence, be cautious. A positive or negative, either way in this table 12 is a problem. Hence, do an invoice-wise reconciliation for this. The work is going to be more, but at least we will have a control over this. Ask the assessee to do this reconciliation. Showed the invoice-wise reconciliation is a much better option, because month on month they are going to maintain this. The serious warning that I want to give is, in 1920, this problem will be multiplied by 2, because in book we would have accounted, but because of this rule 36 sub rule 4, we can avail only if it is appearing in 2A. That will also come into picture. So book accounted, not availed in GST returns because of rule 36 sub rule 4. That invoice wise we have to maintain. And the problem will further get complicated, because September only is the time limit by which we should avail that credit. If the other party is not reporting it by September, then we are disentitled for the credit. So keep this at the back of your mind. What we are going to face in 1920, better to clean the house in 1819 itself. This reconciliation will take time, but worth the effort. Any positive or negative will hit your P&L, is my view. And the other table, which the department, like table 12, they have told that it is not mandatory, it can be taken as an option, is the expenditure head wise ITC availed. At this juncture, I would also prefer to take this option and not disclose it in 1819 because they themselves are told when the data was captured for 1819, we never captured it, envisaging that this is how they will ask. That is why I think they have given the leniency. But the caution again that I want to sound is for 1920, this data was already available, which means the department are already told that this has to be maintained like this for my GST or 9C purposes. Hence, for 1920, we cannot say that I did not know, hence I will not file. And rightly so, department has also not included 1920 in this exemption. This expenditure headwise breakup is mandatorily to be complied for 1920 because so far it is not exempted, which means the same written form continuing 1920 we have to report. So get ready to prepare this data for 1920 when you are finalizing your stat audits. Prepare this data. But for 1819, you may choose to exercise the option because finding out the ITC headwise is going to be a really tiresome job. But when it is given as an option, better to take it because there is no opening balance, closing balance confusion here as we had in table 12. Moving to the next part, the last part, that is the auditor has to prescribe the additional liability. The additional liability can arise because of two reasons. One, turnover missed out on which additional liability is there, or two, ITC wrongly availed on because of which there is a liability of payment. So both of which I can disclose it here. Then what the form GSTR 9C's instruction says is that we have to pay the tax by DRC 03 and it has to be paid only in cash. I have highlighted the term cash for a simple reason. Section 49 does not say so. Section 49 is the payment related section in GST Act. It doesn't say that any tax liability arising on account of annual return or reconciliation by the auditor should be paid only in cash. It doesn't say so. This restriction is put in the, not even in the rules, I would say, as an instruction to the firm 9C. Hence, can be questioned, can be challenged. If you say that I already have enough ITC, I want to make the payment, but I want to make the payment using the ITC, yes, you are free to do. But subject to a litigative possibility because department expects cash to be paid on any differential that is being identified by the auditor. The other word of caution while reconciling your ITC is the problem that we wouldn't have faced in 1718, but we will certainly face in 1819 is refund. Many assessees would have applied for refund. The application would have got accepted, we would have got refund, then there is no problem. But if the application has got rejected, two issues can arise. Rejected, ITC is recredited, no issues. Rejected, but ITC is recredited in the subsequent year. To that extent, your book will show high ITC, credit ledger will show lesser ITC, reconciliation. Rejected and ITC is recredited, it is still not recredited, book will show higher ITC. You have to sound off to the assessee so that he gives a letter to the department officer to get it recredited. All this can form part of your reconciliation problem, especially of ITC. So it is not just the ITC taken in 3B and ITC utilized in 3B, which will be forming part of your returns pertaining to 1819. In 1819 itself, we saw that a lot of refunds applications were being made and we went into the online mode also sometime the later part of 2018-19 from January 2019. Hence, please note, in all these cases, we have to be clear in the reconciliation of ITC. The current asset should only be a real asset staying in our balance sheet whenever we say it is a input tax credit liability, input tax credit, which is capable of being offset against liability. Additional liability, yes, this is the provision. And once it is done, we move to the critical part where the department has again given us an option. In GSTR 9, table 8, what they have told us, the assessee has an option not to fill it up in GSTR 9, but he can do the reconciliation. What is the table 8 in GSTR 9 is 2A reconciliation. The auto-populated data from 2A that can be uploaded along with 9C. So a 9 related table not populated in 9, but in a plain sheet of paper, it can be, the reconciliation can be done and it can be uploaded in along with GSTR 9C is what they have said. And they have clearly told this paper that is getting uploaded need not require certification by the GST auditor. So it is only a voluntary compliance by the assessee. There is no compulsion or requirement of a certificate by the GST auditor. So this is what is pertaining to table 8 of GSTR 9. Can it be uploaded as an additional attachment to GSTR 9C? Yes. And now we move to the part B of our GSTR 9C, the certification. where one of the biggest change that the department brought was, they said from true and correct, they have made it into true and fair. Now going into the certification, I want to dissect the two certification methodologies. One is the first part of the certification in part B, that is when you are the GST auditor as well as the statutory auditor. So where I am the stat auditor and GST auditor, a type of assertions and statements will have to be given. When I am not the statutory auditor, but I'm only a GST auditor, one element is not to be certified by me, because obviously I have not done that work. So what is that carve out, and what are we entering into in terms of the certification? Is the first part, when you are the statutory auditor, rather the statutory auditor is the GST auditor, then we are supposed to say that I've examined the balance sheet, P&L and cash flow statement. Cash flow statement is not mandatory for everybody. Cash flow statement is mandatory only for those people for whom it is mandatory under accounting standard. Then only we have to upload cash flow statement. It is not mandatory under GST law. That has been clarified. So whichever out of this is applicable, whether P&L or income and expenditure statement or the cash flow statement. So balance sheet A and B are there compulsory. It could be P&L or income and expenditure statement depending upon the type of assessee you are. But C is optional, certainly. You have to give that I have examined this and we report the audit of books of accounts and the financial statement. Audit has been done by this person. So the same assertion which we have to give when we are not the statutory auditor. So here we are saying I have examined the P&L balance sheet, and when I am not the statutory auditor, I will say that the audit has been conducted by this person, and which we are just annexing to this audit report, and we, based on that, we have done our reconciliation. So this is where the difference lies between the certification if you are a statutory auditor and the GST auditor vis-a-vis situation where both are different. And the other parts of the certification which are common in both the cases are where we are saying that we report that the registered person has maintained the books of accounts, records and documents. Now this is common for both. When you are the statutory auditor and GST auditor, as well as we are not the statutory auditor but the GST auditor, we are saying this. Hence, we should know first that the assessee is liable to maintain what type of books of accounts, what type of records and what type of documents. This is why I told you earlier when we discussed about GST auditor not being a stat auditor, still a certain element of examination and verification he has to do. He cannot exonerate him from the responsibility of verification or examination. That is what is the assertion that we are giving here will make us do. It says that we are certifying that he has maintained the books of accounts, records and documents as required under the CGST Act or the IGST or the relevant rules or notifications. Hence, we should know what are all those documents, which we will see a little later. I've listed those documents as well as records and the books that needs to be maintained. Since we are giving this, either of the cases we have to certify that we have seen that, and then this is only in the case where the statutory auditor is the GST auditor. For that case only, this point number 3 is going to be reported, where we are saying that these are my observations or comments or discrepancies in the accounts, and then we further report that I have obtained all the information and explanation. So this is a standard text to be given by the person who is a GST auditor as well as a statutory auditor. If you are not a GST, if you are only a GST auditor, not a stat auditor, this point is not applicable for that person. That assessee, we need not report it. So when we choose the appropriate table, that is whether you are a GST auditor as well as statutory auditor, if you choose that option, this will appear. You are a person different from the statutory auditor, you choose that option, this will not appear for you. And further, we have to express the opinion on the books of accounts as well as the examination done by us, as well as the final accounts that which we are giving it. This is what is mandatory for a person who is a statutory as well as a GST auditor. And this point is common for both. That is, we are saying that the documents required to be furnished under section 35 subsection 5, which is the financial statements and the reconciliation statements, are being annexed here to my report. So this is common for both. And finally, in my opinion, and information given to us, the particulars given to us are true and fair, subject to the following observations or qualifications. So this is where we can give our view as to what are all the things the assessee could have done or should have done, missed out, or where we feel that there is an additional liability possibility which we could not capture earlier, or there is a possibility that we are not able to even have the answer as to why we are not able to quantify the liability. In those cases, we can say there is a deviation, but I am not even able to find out the quantity because they have not given me the data. Something of that sort. One example that I can give here, we will have some other separate slide for discussion of possible qualifications and observations. One instant example is the 180 days ITC reversal as per section 16. If you are not paying your supplier within 180 days from the date of invoice, you are supposed to reverse the ITC, add it to the output tax liability, and subsequently when you pay, you are entitled to take it back. Where we even given aging of creditor, that too for the year, across the year, invoice wise, and that too not from the date of booking of invoice, date on which the creditor has raised the invoice. It is not based upon my booking date, it is based upon my supplier's invoice date. Many of the people do not even have this data, meaning they don't maintain this at all. In those cases, how are we going to say that the 180 days compliance has been done by the assessee? In those cases, we cannot quantify, but we have to give an observation or a qualification. We might as well use this place to say that there is no such record maintained, which has not been given. Hence, I am not able to come to a conclusion as to this 180 days compliance has been done or not. We have to give this as an observation. Since it cannot be, we cannot say so much is the liability, since we have not been able to verify. Those are the situations that can give rise to any observations here in this 5 or 4, as the case may be the serial number, depending upon whether you are a statutory auditor or not. The documents that needs to be maintained under GST, I'm just quickly taking you through. One is called as a revised invoice. Tax invoice, yes, all of us know. But when will revised invoice come is a person who is a normal taxable person, who's becoming a normal taxable person from being a unregistered person. Within a time limit, within 30 days, he is supposed to give for the period for which he was given registration retrospectively. That is, I apply for registration today and department gives me registration 10 days from now, but they give it effective from today. Is it possible? Yes. If the department gives like that, then for these 10 days, whatever turnover I have done, I'm supposed to give a revised invoice, and that revised invoice is a document that needs to be maintained. Bill of supply. Wherever we are raising, let's say exempted goods, exempted services, bill of supply will come. We are raising a reimbursement document only because we'll raise an invoice separately. But for claiming reimbursement only, it is a clear reimbursement as per pure agency. It is called as a bill of supply. That has to go. And then a receipt voucher, especially in case of advances. For goods or services, both the cases, receipt voucher shall have to be maintained. In case of service related receipt voucher, GST will also be there. And refund voucher is directly connected to receipt voucher. Another document that needs to be maintained under section 31 of the CGST Act. And this refund voucher is when we have taken the advance is to be given back. The corresponding tax should also be given back. That time we are supposed to raise a refund voucher. In case of goods also, there is no tax that needs to be given back, but refund voucher has to be raised so that the refund voucher will reduce the advance that you have received. Another document that must be maintained under GST and self-invoice, section 31 subsection 3 clause F, as per which when the supplier is unregistered, but RCM is because of 9.3. RCM is not because of 9.4. It could be because of 9.3 or 9.4. But when our supplier is unregistered, I am supposed to raise a self-invoice only. That self-invoice we are supposed to have as a proof of our ITC. On reverse charge, it is not my payment challan which is making me eligible for input tax credit. It is my self-invoice which makes me eligible for my input tax credit. And the payment voucher is the payment that which I am making to my reverse charge supplier. To my reverse charge supplier, if I am making an advance payment, I am supposed to pay GST on the advance itself. That will be captured in the payment voucher, another document under section 31. And delivery challans. Why should delivery challans be accounted? Because it doesn't have any financial impact. It doesn't have any financial impact, but it has a tax impact, especially delivery challans sent for job work or delivery challans in case of supply, meaning it will go now and later on will get billed sale or return basis, or in case of renting. I'm renting my goods, but I'm moving it to you for the purpose of rental. In those cases, I'll have to raise a delivery challan to move it to you. Has it come back? In all those cases, DC will become a key document. Delivery challan, hence the delivery challan documentation should also be there. Now, are these things suddenly cropping up? Certainly not. In GSTR 1, table 13 looks like this. But what happened is after the first or second month of GSTR 1 filing, department made this table 13 non-mandatory. So even if I don't fill up the data in table 13, if I click submit, return will get submitted. And when something is not important in a return, take it from me, none of us will fill it up. Unless it has got this red marker and it forces us that you have to fill it up, then only I'll move to the next one. Nobody is going to bother. Why should I fill it up? Because in 1819 onwards, EVA bill has started. From 1st April 2018, EVA bill has been implemented. Tomorrow, let's say 2 years from now, they do a big data reconciliation and say so much of invoices you have reported, but so less of EVA bills. Why? Or vice versa. So much of EVA bills, why so much of so less of invoices? In those cases, we should be able to tell, sir, so much went for DC purposes, delivery challan. So hence I have raised delivery challan. Then did you report what are all the delivery challans that you raised? No, I never reported. You are supposed to report it in GSTR1, table 13. If you have not reported, then the assessee is considered to be assessee in default, who has not disclosed the data. Hence, my suggestion is, while we are doing the audit, even if the assessee has not reported it here, we can do the documentation in our GSTR 9C, give it as an observation, saying assessee has used invoice number 1 to so and so, for the purpose of invoicing of local supplies. For export invoices, this numeric series has been used. Like that, we can give it as an observation in our GSTR 9C, so that it will add a credibility to the assessee's claim at a later point of time. If he has given it in GSTR1, check the correctness of it and then report it. If the data has not been given in GSTR1, do it as a value addition for the client in the observation, because whatever you report is not only a qualification in the point. You can also give an observation. I have observed that he has used the serial numbers, which means we are quantifying that. So tomorrow, any other serial number, we can say that I have never verified it. One. And second, assessee will also be saved. He will also say, this is what I have done. Whatever your document you have in your hand, it doesn't belong to me. He can also say at the strength of our documentation. So the documents that need to be prepared and by the assessee, which should be maintained by the assessee, which we are supposed to verify, are these. Now coming to the records that need to be maintained by the assessee. There are about 13 different records. This is section 35, read with rule 56. I've tried tabulating all the records that one has to maintain. The manufacturing record has to be maintained. The production or manufacturing record is one. And then supply of services. If you are a service provider or if you have service as an output service, the service register has to be maintained. Then your normal sales register and purchase register. And then stock register will have to be maintained. Input tax credit register. You can merge your ITC register with purchase register. No problem. But the requirement of ITC data should be available from the purchase register. Same way, output tax liability register can be merged with the sales register. No issues. But output tax liability related data, rate wise, state wise, I should be able to extract from it. Ensure that. And import and export data. How much is imported, how much is exported, goods as well as services will have to be clearly maintained as a separate register. And then my RCM, the inward supplies which I have received on which I have paid a reverse charge, should be maintained, because not necessarily all the RCMs that I paid, I would be entitled to take ITC. Some of the cases I wouldn't have been able to or wouldn't have been entitled to take ITC, so show that. And then the outward tax supplies, my outward tax supplies where the other party is liable to pay under reverse charge, rare, but if you are under that type of business, maintain it as a register. And finally, advance received and paid. My payment of advances, my receipt of advances, both will have to be maintained as registers. This is why I said combinedly I see about 12 registers. If you split the advance received and paid into 2, it will become 13 registers that has to be maintained. You can even combine it and maintain it as 4 or 5 also, but all the data that you see on your screen should be available separately, because these have been codified in the same name in the rule 56. So we cannot say that I've been told that I should maintain. Rule 35 sub rule 1 read with rule 56 says that all these records have to be maintained by me, hence mandatory to maintain. We are saying in our audit report that we have verified this, hence please tell the assessee to maintain it, then only we can say that we have verified it. The last part of our discussion, few of the qualifications or observations that can arise during our course of audit is one which I certainly want all of you to make note or go through in the assessee's books is, if you have done any exports, especially if it is export of goods, where there is a requirement that the goods should have left within 3 months from the date of invoice. If it has not left, then the assessee is liable to pay GST as per rule 96 of the CGST rules. In case of goods, when I have taken an LUT, I am giving a undertaking to the department that if it is goods, I will export it within 3 months from the date of invoice. That is the undertaking that is given. If he is not doing it, then within 15 days from the expiry of that 3 months, he is supposed to pay the GST along with interest to the department. How do we know that whether the assessee has exported it within 3 months from the date of invoice? Easiest way is in the IceGate portal, Indian Customs Electronic Gateway portal. When we give the shipping bill number, it will give automatically for the shipping bill number. Shipping bill is the document by which we are able to do an export. Again, the shipping bill number, it will give as to what is the EGM reference, Export General Manifest. What is this Export General Manifest? That is the date on which the goods are deemed to have left India. The day on which goods have left India is this EGM date. So please take that EGM date and do this verification, because LUT condition is breached, liability is certain. It is not even contingent liability. Liability is certain. For the basic value, liability is certain. For the interest, liability is certain. For penalty, you can say contingent liability, because penalty, you are paying suo moto. We will assume that since we have paid suo moto, there is no penalty. But department can very well say that just before me commencing an audit, or just before any kind of communication has come from me, then only you have complied with it. Why can't I say that you are liable to pay? Can arise from the department. Hence, only the penalty can be a contingent liability. This will be a certain liability. On services, major problem area. If you have given LUT and exported services, the condition under which LUT is taken, because LUT, anything that is available easily, we will not respect it that much. LUT has become like that. Earlier, it used to be a tougher thing, because you have to physically go get it from the officer. We know how tough it is to get it. But from 2018-19 onwards, it became electronic. And how it became electronic? Lesser than the time taken to cook any noodles. Lesser than 2 minutes. You just go there, click 3 button, and especially when it comes to websites, we see the word I agree, we always click I agree. We will not even bother about what is there inside that I agree. I agree. Click everything, and then it will ask for 2 witnesses. Put the assessees, 2 employees as witness. Click the button. Next minute, you will get the ARN. And that ARN is deemed to be your LUT. Within 2 minutes, anybody in the office will get this LUT. But the condition that we are clicking and accepting, if you read, it will say in case of services, especially IT and ITES companies, the services for which I am raising an export invoice, I shall recover the money in convertible foreign exchange within 1 year from the date of invoice. That is the undertaking under which they have done this invoice without payment of IGST. So if you have done this and you have not realized the money within 1 year, how will I find out? Debtors aging. Just hit the debtors aging. In debtors aging, you have got export debtors. Export debtors aging more than 1 year. This person has done LUT invoice. 100% tax is liable. From the expiry of 1 year from the date of invoice, if you have not recovered the money from the customer, then you are liable to pay with interest for 1 year. Within 15 days from the expiry of 1 year. So if he is still not paid, he is liable to pay till today interest with the tax. Sir, he has still not realized the money. He is liable to pay till today. Sir, he has not realized within 1 year, but he has realized after 1 year. Maybe say after 1 year and 6 months. Then 1 year and 6 months interest is certain liability. Tax need not be paid, because you can say that, see, if I had paid the tax, I would have got it as refund. Agreed. At least the interest is certain liability. That is what is the criticality of LUT condition. And especially from 18-19, very, very important, because 17-18, there was a confusion till October 2017. Post that circular 8/2017 only, it got settled. And then 18-19 onwards, it has been a seamless process. Hence, LUT conditions checking and qualifying for especially clients having 0 rated supplies. It could be SEZ also. But in case of SEZ, this conditions doesn't impact us. But export clients or assessees having export turnover, these 2 conditions will have to be carefully looked at. And then the other condition, which has become applicable from 23rd of March 2020. 23rd of March 2020, how will it impact May 2018-19? I think it has an implication. It is not made as a retrospective amendment, but it is inserted only in 23rd March 2020, a day before lockdown. What it says is, in case of goods, in my discussion earlier, LUT conditions, I didn't say anything in respect of goods with respect to collection of money. In respect of goods, the expectation under LUT was that you should have sent it out of India within 3 months. But Rule 96B inserted from 23rd March says that in case of export of goods, where you are claiming refund, so it is a subset. It is not for all exports. Export of goods you have done, fine. Are you claiming refund? Yes. Oh, in that case, you should have received the money within the time limit fixed by FEMA. The Foreign Exchange Management Act fixes a time limit. Within the time limit, you should receive the money. The time limit fixed by FEMA for a normal supply transaction, sale transaction is 9 months from the date of invoice. You should have received the money within 9 months. If you have not received the money within 9 months, the refund taken by you shall have to be refunded. Rule 96B. Now tell me, for an audit which we are going to finalize after 23rd of March 2020, will this rule apply or not? It will apply, because any refund which is applied after 23rd March 2020, this applies. So for 2018 April, I am applying today due to the extension time period of given in section 168A. I am applying now for April 2018. So when I am applying for April 2018, they are not saying we will not apply 96B. 96B is applicable today because that provision has come from 23rd March. So when we are going to do and finish our audit and upload the documents from now till say September, within the time also this 96B is applicable. Hence this has to be checked. And then only the export related turnover, whether he has claimed the refund. If he has claimed the refund, both from a financial accounting angle, your normal balance sheet audit also, as well as the GST audits, there is a liability. If he has claimed the refund and the money has not been collected so far, maybe he has written it off or he is keeping it for write-off. He has not done anything, but he has claimed the refund, can hit you. And especially in case of goods, the people could have opted even for with payment of IGST so that the refund would have come automatically from customs. They wouldn't have even made an application. So you will have to dwell deeper into this transaction and ask from them, okay, have you collected everything? 96B's impact, possible qualification or observation. The next one is the difference between export, deemed export and merchant export. Export is separate, deemed export, there are separate compliances. Merchant export, supplying at 0.1% to a person who will further export it. Clearly identify the difference. There are compliance for it. In case of merchant export, the merchant exporter should give me within 3 months from the date of his export, he has to give me the bill of shipping bill copy where my GST number is mentioned in the shipping bill. If it is not the case, then the merchant export transaction is not eligible for 0.1%. You have to go to the 18 or 28%. Please look at this compliance for a merchant export transaction. In case of a deemed export transaction, check whether the actual recipient happens to be anyone who has been notified under the notification 48/2017. Only 4 types of people are allowed under 48/2017. See whether they are coming under the deemed export category only. Could be an EOU, could be an A advance authorization holder, or it could be a EPCG license holder. Check whether they are coming under that category. And the export situations, the compliance check which I just told you should be differently seen, and for every transaction whether that post compliance has happened. This deemed export and merchant export will sound something like the erstwhile C form, because the exporter has to do and give me the forms. The exporter has to prove that he is going to export. All that requirements are still there. So we have to get those documents, and then only we can say we are entitled for a special rate or a special benefit. That compliance, non-compliance can result in qualification. Reverse charge of earlier years. This is why I postponed certain questions there. 2018-19 reverse charge, we are identifying and we are asking the assessee to pay today. Assessee is paying today. How is it to be reported? In GSTR 9, they have already clarified in the 4th of July circular, 4th of July 2019 circular, that we need not report the payable. We need to report only what is paid. Now, 2018-19's reverse charge, if I pay today, first question, if it is paid today, can I avail ITC? Second question, if I am paying today, in 2018-19 GSTR, 9 and 9C should I show? That question I think I've answered. You don't have to report it in 9 and 9C of that year. But in 9C, you may have to make a observation that it has not been paid in 18-19, but it has been subsequently paid. Use the observation and qualification column, because there we are going to tell it has been paid subsequently in 2020-21. When we completed the audit, maybe in August 2020 they paid, mention that there. One, liability reporting is to be taken care like that. Second, ITC availment. Can they avail ITC if they have paid it now? Now this is a contentious issue. What I'm going to give is my personal view, and I'm 100% sure there is equally opposite, stronger view. Like for example, my yesterday's speaker wouldn't agree with this. We have had a discussion on this point. I am of the view that if I am going to pay the GST only today, that is the reverse charge GST, I'm entitled to take the ITC because I'm liable to pay interest. No, my time of supply has occurred in 2018 itself. Let's say in June 2018, my time of supply has arisen and I am liable to pay reverse charge in June 2018. but I have not paid it in June 2018. I am paying it in August 2020. So for my delay of 2 years and 2 months, I am ready to pay interest. Then why should I be penalized one more time to pay the tax and not avail ITC? That will become double jeopardy. For the delay, I am ready to pay interest, but you should allow me to take ITC. That is what is my contention. So take the view whichever suits you as well as your client. But this is something which is not there in law. It will become a contentious issue. It will get settled over a period of time only by way of any legal judgments or any amendments to the law. Moving to the next part, interest. We are in an interesting situation in interest because the whole world knows the 24th March press release, subsequently given after the COVID relief, also reiterated the point that interest is only on net. It is not on gross. Retrospective amendment will be given. That is what the press release reads. But while doing GSTR 9C audit, can I go by press release? I should go only by notification or a circular given by the department. Hence, we have to take a stand. So this is the place where we have to decide. Assessee has a liability. He has to pay interest in gross or net. Take a stand and substantiate your stand. Both the points I have told you. The department has told that we will come up with a retrospective amendment. In that expectation, assessee has paid in net could be one point of view. No. As of today, the law is not enabled, meaning the provisions are not put in the section. Then how can I say pay it on net? I will say only it is paid on gross, because that is when the financial statements will reflect the true and fair view. If you go by that logic, yes, you can adopt it. But this is going to be a crossroad. You have to cross it with any one of the option only. And that has effectively brought me to the end of today's presentation. I think, yeah, as planned, I was targeting 7:30, 3 minutes earlier, or I would say taking the 5 minutes of break also. It is 7-8 minutes earlier. I will stop here and then I will go back to that stop sharing and ask our chairman, sir, to show the questions so that we can answer the questions one by one. Okay, maybe he's not around. I'll go through the questions.
1 minute, sir. Just
Yeah.
sir.
Shankar sir, can you hear
Yes.
me? Am I audible?
Yeah. Yes, Abhishek.
Shall we take the question and answers?
Yes.
We can take it from the chat window itself.
Yeah, I'm trying to browse the
No,
ones. which are
I'll
not there.
just flash it on the screen, Shankar. Just give me a moment.
Okay. DC is back. Yes, sir.
Yeah. He has a presenter, right? So usually he will.
No, I will have to take the rights actually.
Okay.
That's it.
No, so I have changed it. You can straight away share a screen.
There are almost 60 questions. 60 minus whatever you have taken, you'll have to now cover.
Okay.
Is it coming on the screen? I don't think so.
Not yet.
Not yet.
1 second, sir. I'll do it again.
It's coming.
Yeah, it's coming. Okay.
Yeah, it has come.
We stopped with this 13th question. Shankar, maybe you can read and answer so that they'll save a lot of time.
Yeah, I'll do that. Input received, interest rate. Okay, I think we have answered that question. We cannot do the changes in GSTR 9. Let me go to 14. Yeah, 14 also I think we have answered.
Okay.
15 is also done. Yes, 15 also we have answered, saying that proportionate is only applicable if you cannot substantiate for T4. Yeah, please, if you can come down below 15. It is, the screen is frozen.
Credit note is raised only for difference in tax.
1 minute. The screen is frozen, I believe.
Just see.
Yeah, now I am able to see. Yes, yes, yes. Yeah, 16. I am able to see 16. When credit note is raised only for difference in rate. Yes, I think this also I have told that the 3 columns, how to use it. 17. A company has GST registration in multiple state. Can they have GST audits for each branch separately? Each registration? Yes, possible. And can...
Sorry, one second.
No, it's
Sorry.
okay.
Yeah, please. Now,
Being a statutory auditor signing only HO, GST or 9C. As you said, should I obtain separate TB for each registration? Absolutely. Separate TB is the basis for you to give the certificate. You can have multiple GST auditors across one for every registration possible. 18. Purchase invoice dated 29/3/2019. Okay. But material received on 2/4/2000. Assessee taken entry in the books of account 1920. So 1920, correct. But 2A 1890, please clarify. So 2A will appear only in 1818 because my supplier, it is a supplier on that day. You are entitled to take credit in 1920, and this is what we are going to disclose it as in the 9C table 12, where I told you booked in the previous year or pertaining to the previous year, availed in the subsequent year. So this is not a problem at all. There is no hard and fast rule that it has to be taken in that year only. Absolutely not. Question number 19. Is GST applicable on notice recovery amount or any other amount received from an employee at the time of leaving of his company? Also, a food amount recovered, GST is applicable on that. Again, it is a question which is, I would say, interpretation oriented. In my view, yes, both are taxable because the employee is no more an employee for these two purposes, or for the purpose of food and food recovery that is being done. It is not just on the recovery. Food is a service that is given. So the open market value, there will be taxability. Please go through Rule 28 also to get a clarity on the valuation. Date of invoice 28/3/2019, accounted 1/4, declared in 3B, considered in financials of 1920. Fine. Should the invoice dated 29 be part of GST or 9C in part 3? Serial number 9E. No. See, you are... Okay. Invoice is dated. Absolutely. Because your invoice is dated 2018-19, but it is accounted in 1920. How can it happen? It should not happen. No, ideally, from an accounting perspective, 1819 invoice should have got accounted only in 1819.
no, Shankar, if the goods arrive late, on the date of receipt of goods only you can do now.
Correct, but she is talking about GSTR1. So I'm assuming that it is their outward supply.
Okay.
So GSTR1 of the supplier, then I can actually...
I got it.
Yeah, so I am thinking that this... Okay, if this is the case, it is wrong because your current year turnover, you have not reported in the current year.
Correct.
So it has to be reported in the current year as additional liability. Yes. Maybe you can say that this year turnover in GSTR 9, in table 10, you have an option to say current year invoices reported and paid subsequently. In table 10, you have an option. There you report it so that the liability will not arise, but tax payable will be there and it has been subsequently paid. Is how you have to close the difference. The difference will come. You have to show that as a subsequently paid transaction. Move to the next question, sir. 21. RCM not paid in FY 18-19, but now can the assessee pay the amount and claim ITC? I think I've answered that question last part of my presentation. So let's go to the next one. Short payment of interest relating to October 18 has been paid through DRC03 now. Okay. Should this be disclosed in 9C? Okay. In 9C for 18-19, interest, penalty, late fees, whatever is paid under that head should also be disclosed. Hence, please disclose it. It will not come from 3B. This amount paid will come as a difference. But below the table 9, you can type it out saying that this amount of difference has actually been paid through DRC03. Hence, the system populates only the payment as per 3B. So the difference is not actually resulting in a liability. Word it in this way and report it there. It is bound to give a difference, but difference is not a harming difference. 23. The assessee purchased the material and paid it to the supplier, but the supplier not entered. Purchased the material and paid it to the supplier, not entered. Now we can ITC credit or not. Okay, now we can take ITC credit or not. For 2018-19, I'm assuming this question is that. Then for 2018-19, the mandatory matching was not applicable. For 2018-19, it became applicable only from 9th October 2019 by virtue of this notification 49/2019. Hence, you don't have to worry about it for 18-19. As long as you are in possession of an invoice, you are entitled to take ITC. Question number 24. Section 15 adjustments will include the sale of asset not used by a dealer where tax paid is in the margin scheme. Sale of an asset, can you pay under margin scheme is a question, because sale of an asset by you, which you are using it, will not come under used goods transactions. Used good transaction is, you should be a person who is dealing in used goods. If it is your asset which is being sold, as I suggested, 5O would be the appropriate place rather than 5M. Disposal of asset 25 will come in deemed supply under schedule 1. Then why the same should come in 5O? Sir, disposal of asset without consideration will come in deemed supply. Disposal of asset with the consideration will come in 5O. Deemed supply is what schedule 1 is, transactions which without consideration was deemed to be a supply. So it will come there, where you will not have a turnover at all in your books. But whereas in this case, there will be an inflow of cash when I am selling an asset. So 5O and the schedule 1, the difference is this. 26. Tax audit is not done for the assessee. What does the GST auditor has to do in part B certification part, since there is no audited P&L and balance sheet? Same answer as I told you earlier. Assume that the GST audit is the audit, because it is not tax audit. It could be any audit. If the assessee is not subjected to any other audit under any other law for the time being enforced, then call him as an assessee taxable under GST audit only, and say that the audit has been done by me only as a start audit for GST as well as this. Whether you are able to get 2 fees, that I leave it to you. Once for the audit and once for the GST audit. 27. In case of rental services, should all the premises be declared as additional place of business? In case the client have not done, report it in 9C. Again, there are two schools of thoughts. My view is the place which is rented is not considered to be my additional place of business unless I'm storing anything or doing anything there. So I strongly hold the view that my place of business is where I have got registered. These need not be disclosed as additional place of business. Hence, I wouldn't qualify. 28. Question.
I think the question got trimmed actually. What happens is give more than some characters.
Oh, that's a
Trimmed.
Registration only in Chennai, probably maintained.
You can, as a speaker, you can guess an answer.
I'm trying to. Seems to be a bigger challenge than GST. Registration only in Chennai. They are charging IGST on Delhi property rent. Okay. Should registration be obtained in Delhi jurisdiction? Sir, question is with respect to place of supply. You are asking in GST audit. Still, my view on the previous answer, previous question's answer holds good here also. I am of the view that I can charge IGST. I need not get registered in Delhi. That is my view.
It has to report the same 9C.
It doesn't have to be reported in 9C. You can charge IGST. You are entitled to charge IGST. Place of supply is always going to be Delhi. As long as place of supply is Delhi, the revenue is going to be shared by the government with Delhi only. Whether you go and get registered there and file a return there, it is still going to go to SGST Delhi. You are going to file the return from here. It is going to go as IGST shared with Delhi government. So it doesn't make a difference. So you'll have to appreciate section 17 of IGST Act, where the sharing mechanism is detailed. According to that, I don't think there is a problem.
Next is also same only.
Okay.
So Sriram has asked a lot of questions. Yesterday we had CS Sumlata asking a lot of questions, where we told Ganesh Prabhu to send the bill. So today you can send a bill to CS Sriram.
Time of supply is not being followed as per the provisions of GST. Absolutely, yes, you have to tell, no? Time of supply is not followed. It will result in interest liability. You will have to qualify and quantify the interest liability also. Is there any external data available in IceGate to counter verify the IGST on imports? IceGate is open for everybody, sir. As long as you have a bill of entry in your hand, you can go and type the bill of entry number. It will give you the whole horoscope of the bill of entry. Same way for a shipping bill. It will give everything. Anybody can do it. There is no login that is required. There are instances where the client doesn't maintain records of inputs taken in 3B. Excellent. No breakup available for ITC availed in 3B. How to go about this? Create one. That's all. Because if you don't have a breakup, you need to have a breakup. If there is no breakup, qualify that the whole ITC is not a proper ITC. How to create a separate assignment?
Correct.
Moving to the next part. Audited financial statement. Sriram seems to have monopolized all the questions.
I told you he's kind of ready and he has given the.
Okay. Yeah, 622 he has posted the question. So maybe he was ready with the questions. Audited financial statement should be certified only after conclusion of audit. Okay. In case of GST audit, the audit is being carried out at a later date. Under these circumstances, should the audit and financial should be drawn separately for GST audit? Not necessarily. You have already signed the audit. See, it is a static data. We are comparing the static data with the static data of that year only. Because you have filed the returns of that year also. Were you able to modify your returns post that year? GST audits, GST audit is based upon the returns. The returns filed in that year with the audited accounts of that year, I don't see the need for another change or a change to balance sheet and all. Nothing, no, not required. 33. Administrative services provided by a branch at one state to another branch at another state. Should it be considered as involving deemed supply? To answer this question, please read rule number 28, second proviso. You will get the answer. If that answer to that question is yes, you are entitled to take full ITC, then the answer to this question is no. If that question answer is no, then for this question the answer is yes. Come to 34. Where to report limitation of scope with respect to GST audit? Is there any option to disclaim our opinion? Okay, with respect to what? In any case, we need to provide assurance for figures how to go about it. These are audit methods that you need to adopt, audit procedures that you need to adopt, but still you feel that the data is too much, or the sampling that you adopt, you better report those limitations in the observations itself. It is possible. The last point of observation which I discussed, there you can report it. If there is going to be an inherent problem of sampling that you want to bring about in the GST audit, yes, it can be. But I am of the view that since we are discussing only three parts of the tax liability, that is the output, input, and tax paid, we shouldn't have much of a difficulty in getting those data. If that is data is not available, then it is a bigger problem. It is not an audit limitation. It is an auditee's limitation. Question number 35. One of our client received a yearly discount from cement manufacturer. Okay, I can guess the question, but it was inadvertently omitted to be disclosed in the audit of financial statement, but was correctly revised ITC in the GST March month. Same has been corrected in the audit of financial statement 1880. Please advise how. Simple, sir. It will show us a difference in this year. Say that it has already been corrected by way of next year accounting. In the subsequent year, it has been accounted properly. Or in case if 2017-18 it came as a difference, in this year you can say that in 2017-18 you should have said that it has got subsequently been taken care in 18-19, which is why I told you the difference can arise, but differences are always not harmful. So you can mention subsequently to that this has been subsequently adjusted, hence there is no tax liability. Difference is there, but difference doesn't result in tax liability. Those wordings, if you are able to come to a conclusion, give it. That is what will save the assessee from a notice. Okay, 36. ITC reversal applicable on post-sale discount credit notes received from suppliers like turnover or target discount incentives. If no, then in which table to show such income in both GST 9 and 9C? First thing, it is a matter of how you have accounted it in your books of accounts. It is not about how to show it in 9 or 9C. I'll clarify that. ITC reversal, is it mandatory? If the credit note contains GST, it is mandatory. If the credit note does not contain GST, you don't have to reverse ITC. If the credit note does not contain GST, should I take it as my income? Certainly not. It is a disclosure. In case of a trader, we are following a method of accounting wherein that discount is being disclosed as other income in our P&L. It does not mean that it is a supply. It is disclosed as other income, but is it a supply? Certainly not. It is an adjustment to a supply. So the purchases value is sitting on the debit side. The discount, instead of being reduced from the purchases value, it is being shown as an income because of matching. Maybe the stock was sold already. So why would I go and reduce it from purchases? Hence, I am showing it in the credit side. A disclosure in accounting resulting in increase in income does not mean supply. What is taxable in GST is supply, not income. So you can have a difference between your income and supply under GST, and you can substantiate and say that this is an income or this is a reduction in my expense which has been disclosed in this way, and there is no GST liability on it. Because actually, when you purchased for 100, you would have paid GST on 100. 18 rupees, you would have taken ITC. Subsequently, the seller to you is giving 10 rupee discount. You are now reducing your purchase value to 90. Instead, you are showing 100 in the purchase debit and 10 in the discount credit. You have already paid on the 100 full tax. That is the question of reversal. Don't do it. Don't show it as a potential tax liability. Absolutely not. Should we report expenses like salaries, rent, electricity under 4C of GSTR 4? GSTR 4, yes, though outside the purview of this discussion, not salaries, rent, and electricity, only your purchases. Go by the logic of supply, as we just discussed. There also it applies. What is your inward supply? Please report that only. Assessee is selling exempted goods, apples, and his turnover is 10 crore. Is GST audit applicable? Is he registered? I'm assuming that you asked this question because he is registered. If he is registered, then yes, GST audit is applicable. Because I'll give you an interesting perspective also. If he is exporting Apple, it is called zero rate of turnover. And he is entitled even to claim refund. So you are very well advised to file the GST 9 and 9C also. Because that since you are registered, if you are not registered because you are availing the exemption under section number 23, then yes, you can say that you don't even have to bother about 9 or 9C because you're not registered. 39. If supplies on which tax is to be paid by recipient on reverse charge basis is reported under exempted in 3B, then there is a possibility to reverse ITC. What is the solution? We will have to correct it, sir. We will have to correct it in our GSTR 9. We ask the assessee to correct it in 9. If the assessee is not correcting it and wrongly reporting it, correct it properly and report it in 9C. That will be the way, because if you show it as exempted, there is always going to be a reversal notice from the department. The correction has to happen in 9, reflected in 9C. If it has not happened in 9, reflected in 9C. And for all we know, tax audit report and tax audit, income tax return, how it goes hand in hand, 9 and 9C goes hand in hand. We will say it is client's responsibility and client will only file 9. Question number 40, Arvind has asked, a trust having taxable supply in one state exceeding 5 crore, but other state only donations are received, which is not a supply at all. Should GST 9C be filed in all the states where there is no supply? Have you registered? If you are registered in those states also, minimum return has to be filed, meaning the 9 and 9C will have to be filed, even if it is nil. In this case, even exempted, the donation is not even coming within the purview of GST, even if it is nil, as long as the registration is maintained, it has to be filed. 41. Export done in September 18, IGST paid is shown along with local IGST under 3. Okay, table 3A1 instead of 3A2 in 3B. No issues. Correct it in 9, sir. That's all. Correct it in 9, and if it is correct, reflect the same way in 9C also. That's it. Your problem is solved. 42 is also the same question's repetition, so I'm skipping that. 43. Can we claim input tax credit for the expenditure incurred for constructing a commercial complex which is let out and subject to GST? You may have to wait for the Safari case law judgment of Orissa High Court, now being subjected to the Supreme Court's view under the special leave petition. Once the judgment comes, Supreme Court views in your favor, you can. But till the time, if you are signing GST 9C before that, I would suggest you to give the appropriate qualification or observation, if the assessee prefers to have ITC. Okay, Alvin has qualified already. He is saying it is not relating to 9C. It is relating to refund. Inward supplies are oil, 5%. Okay, packing material 18%. Output are packed. Absolutely, we are eligible for inverted duty structure refund. You can get. We have got refund inverted duty structure. Please go through VKC software judgment 2 weeks back given by Gujarat High Court. That will help you in getting inverted duty structure refund on input services also, as long as it is still not stayed by the Supreme Court. In Tamil Nadu, if you are applying, you will have to apply and go for a writ petition if it is stayed. 45. Hi sir, in case of a company who has incorporated before 15 months, in those cases, as we know that the statutory audit report is made for 15 months. At the time of providing the audit report under 9C, do we also have to attach the tax audit report? Yes, unique situation, sir. I've never envisaged this. Yes, it is possible. In those cases, it is better. But for tax audit purposes, do you prepare a balance sheet? I doubt, because you will prepare, if you are preparing a balance sheet and P&L, then you might as well show that as your statutory audit, because don't say that for that year you are under Companies Act, because Companies Act cuts across 15 months in this case, cuts across a financial year. So you can adopt that which you have used as a cutoff for income tax filing, 1 year filing. That if it has been certified, audited, you can use it, sir. Yes, possible scenario. 46. Yeah, 46 now I can see. Can we avail ITC even if the supplier has not filed GSTR 1? Since there was a rumor that we can avail irrespective of filing GSTR 1, should be restricted to 20%. Sir, again, I am assuming that it is a question for 1819. 1819, we don't have a problem. We can avail as long as we are in possession of the invoice. From 9th October 2019 only, this restriction will apply, and it is still not 20%. From 1st January 2020, it has been reduced to 10%. Please go through that. Rule 36 sub Rule 4 as amended. for the current year. 2A versus 3B RICO. How far is it required for 1819? And 2A came into the midst of 1920. It's not 1819. RICO between GL, ITC and 3B. GL and 3B is sufficient. But as I said towards the end of my presentation, the table 8 uploading along with GSTR 9C, which they have given as an option. At a later point of time, department can issue notices saying, we were always expecting it to be reported. But now you go and find out that reconciliation. Even if you go and push your supplier, he cannot report it in his GSTR1 because 1819 invoice can never be uploaded now. So it is better you can identify those suppliers who have not done it. Maybe sit with them and find out whether they have actually paid the tax, because there is section 16 subsection 2 clause C is not diluted. It still says only if the tax is received by the government, I'll give you ITC. That section still holds good. We can try to fight it in a court of law, but that section still being there, you will have to do the reconciliation, is my view. From an assessee's proprietary safeguarding of asset perspective, ask him to do this. 48. I have a question on ITC availed as per books in 12A. Do we have to consider ITC booked as per the books or ITC claimed in 3B? We have to take only what is booked as per the books, because booked as per the books less what is utilized as per 3B will only result in your closing balance. That should ideally be the closing balance. And the closing balance in all probability should match with the electronic credit ledger, barring some explainable differences. For example, if you do this, March month return we would have filed only in April. So books, we would have already accounted for the March month liability as well as the net off of the entries. But the March month entries would have come in the GST electronic credit ledger only in April. That should be the only difference. Barring that, there should not be any differences. 49. Is it okay if the party claims ITC in a piecemeal on same purchase invoice? Maybe for 2A matching compulsion for 110 a 2A figure in a similar reason. That is ITC or the same invoice claimed in 1 or 2 months, but total not exceeded total ITC. There is nowhere it is told that we should not do this, sir. I think I have given you the answer. We'll move to the next part. Rate of interest. Sriram comes back. Rate of interest for excess claim of ITC, 18% or 24%. I am still of the view everything is 18% only in GST as of today, because section 50 subsection 3, which talks about 24%, talks about 42 subsection 10 and 43 subsection 10, which are matching. Matching is still not enabled in the GST portal, 3 years now. So I don't think 24% can come in any of the situations. It is only 18. Next question. 51. Dealer manufacturer is paying Smith Cooley, okay, by way of allowing wastage. Trading account shows purchase sales, okay, closing stock. Whether reduction in gold weight is deemed as sales, and how to account Smith Cooley. How to account Smith Cooley? If you are not a related person, the value of that wastage that you are allowing shall have to be accounted. So that is an accounting call that you will have to take. If you are a related person, then GST will have to give you an answer in Rule 28. But the wastage, will it be deemed as a supply? Certainly not. There cannot be two supplies. The wastage is allowed for him. That is what is given as a consideration. That is taxable in his hand. And you are entitled to take ITC. If he is giving an invoice, treating that amount which you are allowing him as wastage as a income, he has to give you an invoice. You take ITC on it. There is no problem. You don't take ITC. He doesn't give an invoice. Still also the law is satisfied, because that is considered to be a supply by an unregistered person. So I don't see an issue there. 52. One of our client paid IGST using ITC erroneously, but they have CGST and SGST liability. Can we set off with each other? Paid IGST using ITC, okay, erroneously, but they have CGST and SGST liability. Can we opt it? In annual return, we cannot do anything of the sort. What has been paid only should have to be disclosed, and anything arising because of this, you will have to ask them to pay the correct tax. That is as per section 77, read with section 19 of IGST. Pay the correct tax, claim refund of the wrong tax if it is within 2 years time limit, and you don't have to pay any interest. That is the recourse that is available for you. You cannot adjust. 53. Whether tax already paid for 1819 through DRC appear in part 5 of GSTR 9, it will not come automatically. You will have to populate. In GSTR 9, sorry, GSTR 9 table 9, it will never come at all. In 9C only, you will have to tell that it is going to be, the difference is because of DRC 03. 54. Which part of certification to opt if the client is not subject to any stat audit? The same answer, Sriram, you have to call that you are the statutory auditor. Because the audit is under GST only, the certification is also under GST only. So you'll have to go by that logic. Remember the 2 fees example that I gave you. You will never forget this. The 55, 180 days payment condition, whether applies to for imports also, certainly not. It applies only to those situations where the other party is also liable to pay GST within India. It is actually a counterbalancing mechanism which they have put in. The supplier is not paid, he will not pay GST. So what they have tried doing is to make you pay the supplier, make you pay to your supplier within 180 days. In case of import, you are taking credit for the tax that you have paid through the bill of entry. So you are entitled to take credit. 180 days doesn't apply there. 56. In the case of a fire accident and fixed assets is lost in it, and the assets are capitalized under GST before GST era, and the client is unable to provide all the invoices for our verification, can we get a disclaimer to that extent in 9C? The disclaimer is from reversal of ITC, if any, required on the assets lost in an accident. Sir, very simple. He is not able to give the value of ITC that was availed by him in the erstwhile law. Let us assume it is under central excise as well as under VAT. In those cases, you can still say that today's standing value of those goods as per the books of accounts is this much. Apply today's GST rate and say that this is what is the amount that I feel that you should have paid as tax. Either you give me the documents, we will reverse only the ITC that has been taken long back, considering the 5-year window. If that is not there, please pay the tax as of today. That is what would be my suggestion. Please consider section 18 subsection 6 also while deciding on this. 57. Can we claim reimbursement in same invoice raised for services? Will GST be applicable on that? Certainly not. I have explained it with a practical example also. That is in our auditor's case itself. You can claim it in the same. What should be done if the payment to creditor was not made within 180 days, but after 180 days in the same year, for which registered person not reversed and reclaimed? Interest qualification has to be done. If you are able to identify this, interest is certain. You should have reversed and then you should have reclaimed. For the intermittent period, you have not done that. For the period of delay, not reversed, but still using the credit, you should pay interest. Actually, it will affect your financial books also. That is a certain liability. That is not a contingent liability. Pavan is asking, sir, please explain levy sections of exports. Sorry, Pavan, not able to do today. We'll help you some other time. Whether money received from PayPal for export of services justifies LUT condition. Technically, yes. Again, I had to read FEMA for this, where PayPal, we realized that it is a Nostro or Vostro, I don't remember that logic. They said that is that account, hence they receive it through the Forex and they in turn through a banker, HSBC or someone, and then they give a certificate that we have received the foreign currency, but you will be credited with INR. So we treated in those cases as exports, assuming that it has satisfied the condition of LUT, meaning realizing the money in convertible foreign exchange. Check with them for getting a certificate from the bank which has received the foreign currency on behalf of them. As an auditor, how can I report purchases made by the client without GST levy, where the auditor believes that all the purchases should have been GST invoices? Go through the invoice, sir, see whether there is a GST number on that invoice. If there is no GST number on that invoice, then it means that he is purchased it from an unregistered person. We cannot impose saying that I feel that he is a registered person unless we have a documentary evidence. If in the document it is mentioned that he has procured it from a registered person, then also it is his prerogative to decide not to avail ITC. If he has decided that, we cannot say anything. No, if he avails ITC only, we are supposed to scrutinize and tell whether the ITC is valid or not. It is his prerogative, so leave it.
Yeah, there are some more questions. Can we take Ganesh, Shankar? There are some more questions.
Yes.
I'll just
put it up on the screen.
Yeah, I'll do that. I'll do that.
Okay.
I will maybe shade it and then you can pull. Once again, 1923. This we have already taken. 1924. Sir, in GSTR 4, is invoice wise breakup is given to be given, or GSTN wise purchase is enough?
Sir, GSTR 4 is annual return for composition taxable person. That way in which the data is asked, that Excel I have not got it by heart. So that Excel, whatever data is being asked, that has to be given. Like the electricity and the salary question that was asked, that I could answer because that is not to be reported there. The breakup is asked there, invoice wise, yes, then we have to report it.
Is interest applicable on reversal of ITC wrongly availed?
Certainly it is applicable, 18% interest, because that has resulted in delay in payment of tax. But if you can prove that you have not utilized that ITC at all, ITC wrongly availed 10,000, but my credit ledger balance has remained more than 10,000 for right across the period till I reversed, then you can challenge saying I will not pay interest because I have not used that interest technically.
Sriram again, in case
Yeah.
wherein RCM supplies on which no entitlement of ITC exists.
There seems to purchase return. Sorry, I'll read it again. In case where RCM supplies on which no entitlement of ITC exists, there seems to purchase return. Can RCM be paid at the later stage, net of returns? Could time of supply in this case be relaxed? Certainly not possible. Relaxation and all is not there. You can pay the RCM on that amount, and subsequently you can adjust it also. There is a circular on this, April 2019. I don't remember the circular number. It is there. The circular clarifies that you can, whatever that you paid excess, you can offset it subsequently, or if you are not able to offset, you can claim it as refund, possible. But not delaying the time of supply. There is no provision for delaying the time of supply. Composition dealer paid a tax under 3B. July to September 2019. Once, while filing 4, he paid the same tax amount. I'm assuming your question is for 2017-18 only because you have mentioned 17-18. 2017-18 refund claiming period is time barred, sir. 2 years is long gone. I don't think you'll be able to get any refund unless it is going to be March month refund. March month of 2018, because from 20th of March 2018 till 30th of August 2020, anything which is falling due, 20th of March 2020 to 30th of August 2020, anything is falling due, that shall all be postponed to 31st of August. That is the amendment brought out by circular notification number 55, read with section 168A. So if it is relating to March, you can attempt. You can simply say the tax has been paid in excess. If you are not able to do it under excess payment of tax tab in the refund, please try to do it by any other refund, substantiate with the documentation. The client filed a 3B very late and not paid interest. How to report it in 9C? Interest liability, additional liability. We are not supposed to say only the tax liability. We are supposed to say the interest liability also. Quantify and say that this is the additional liability prescribed with the auditor. We have to tell it. Is circular number 12/2018 is applicable for 18-19 also? Sir, circular number 12/2018, there is no such circular. I'm not sure because in 2017 itself we have crossed 26 circulars. And GST circulars are named continuously, so I'm not able to understand this 12/2018. Can you repost the question? Prabhakar says yes. Okay, sir. And then next question is
something else. Yeah.
Okay. Is it required to match the figures in table 12C in GST RNG with the table 13 of 9? Absolutely yes. You have got it right, because in 9 you are telling that this is the ITC pertaining to this year, availed subsequently. And how can you say that it is different in 9C? Yes, it has to come there. Credit note with IGST, but there is no IGST output in the ledger. Okay. Now, how to record the same in the system? Does not allow the record negative values. Absolutely yes. You'll have to wait until you have an IGST liability. If IGST liability is not appearing, you can apply for refund of that IGST, for which you have raised a credit note. Both options are available. Read circular number 125, 18th November 2019, pertaining to refund on this. There is a specific paragraph on this.
Yeah, just give me a second, Ganesh. We'll take some more questions.
Okay.
I think there are very few, but we'll take those so that
sure,
every query is getting. Has it come on the screen?
Not yet. It is coming. Screen
okay, now
it has started.
Once again, I'll just scroll it down.
Yeah, work in progress. Work in progress.
I think there's only one. What are the ineligible RCM ITC?
whatever ITCs are ineligible under 17 subsection 5 are all ineligible under RCM situation also. Whether it is RCM or forward charge, in either of the cases, what is blocked credit is ineligible. So there is no specific RCM ineligibility.
This did we take, Shankar?
Credit note, yes. That is the last question that I took.
I think we have covered all the questions in that case. Just let me check if anything else has come. Abhishek, you just check in Q&A, anything else?
One question has come from CA Balaji. How to calculate interest under Rule 43 for reversal of proportionate input tax credit of capital goods?
Rule 43, if your client is liable to reverse, I pity the client because you have to do it for 59 months till the asset is reaching the 60th month. So every month, say for example, August 2018 is when you have purchased the asset, you will have to do the first reversal in August month return. There is no interest. But the second reversal, 1/60 into exempted turnover divided by total turnover, done in September month return, you will have to pay 1 month interest on that amount to be reversed. Likewise, you will have to keep on doing it for 59 months. All the best.
One more, sir. The industry of pesticides and fertilizers will have a lot of sales returns during the month of February and March.
Okay.
They have reported the same as input with zero output. Is this correct?
Because of sales returns, they are reporting the I'm not able to
input. They have reported the same as input with zero output.
I'm not able to understand what they have done. Are they reporting it in 3B like this? Maybe you can ask
Maybe,
the person.
maybe you can type out the question again, CA Chaitanya. CA Abhishek covered is if there is exempted sales, then RCM input also to be reversed, is it? He's asking.
Absolutely. Any ITC, if your output is going to be exempted, it is going to be subjected to the same thing. See, it is like a bank account. Your ITC comes into the bank account by any reason. It could be due to RCM or it could be due to normal. But how you use it, that depends on the next question. But the first question is, are you entitled to claim that ITC? The claiming of that ITC itself, there is a restriction, which is what is the exempted turnover being there. 17 subsection 2 and 17 subsection 3. So proportionate only you become eligible. Proportionate only can reach your bank account. Then you use it in whichever way you want.
CA Sumalata. Sir, where to declare the financial credit note?
Financial credit note, we just discussed, no, E, F and J. In that, where it is acceptable, it has been done in the accounts, not acceptable under GST. In that place, you'll have to declare it. 5, table 5, E, F and J, in that F and J. It is a trade discount or it is a credit note. F or J, accordingly, you'll have to disclose. You cannot disclose it in GST R1. System will not even accept because financial credit note tax is 0. System will not accept in GST R1.
CA Balaji. If the reversal amount is not paid in cash and is set off with ITC, is interest still applicable?
Interest is certainly applicable, sir. Interest, there is no doubt. The dubious point or a stand that we can take is, though the department has said you have to pay it in cash, we are paying it by ITC. That is the one which I think we can take a stand fighting for a legal battle. But interest, there is no period of limitation also. You are liable to pay.
CAGV Babu. Credit notes issued by suppliers shown as exempt income. What will be the effect of this?
Okay, don't show it as exempt income. In 9 and 9C, please correct it. As I said earlier, it is only an adjustment to your purchase, which is disclosed in a certain way in accounting. It is certainly not your supply. So maybe declare it under no supply to match it with your income. But don't show it as exempted income, because if you say exempted income, ITC reversal will come.
CA Purushottam Reddy. Can we claim the ITC paid under RCM for financial year 2018-19 as paid in the year 2021?
Yeah, the same answer as I given you earlier. It is a contentious issue. If you are paying interest, I am of the view that you can take. But equally opposite views, since the period is already gone, we cannot take, is the opposite view. You have to decide, take a stand, wait for the legal battle to happen in the days to come.
Here, Rajendra Prasad. Sir, he is asking there is no sale and purchase. Okay, I think he is referring to some other.
Referring to some other question, yeah.
Okay, CA Chaitanya is, I think, corrected it. Output is minus 100 or as per GST R1.
Understood. So I have a sales.
The same as 0.
Yeah, I have understood the question. I have a sales during the month. The pesticide questions only. That is, I think.
Yes.
So I've got a sales, but I have got returns more than the sales. In that case, am I eligible to report negative? You cannot report negative. You can report it as 0 and then continue to report the positive number only when you have a positive in the subsequent months. In those cases, reconciliation will have to happen between GSTR monthly filings with your 9. So maybe I would suggest you to report the net number in 9 only. That is what is as per your books. 3B does not accept negative numbers.
Yeah, we'll take the last question, Abhishek. One.
Yeah, I will take it from Arun Balaji. In GSTR 9, for output, we should be matching the turnover in the books. But in case of ITC, we should only be giving the breakup of the input claimed in 3B. Is that so?
In 3B, okay. In case of C, what we are matching in 9C, I'll explain these two. What we are matching in 9C is our turnover for the year is matched in 9C for output tax perspective. But from an input tax perspective, what we are matching is the credit that is availed during the year. So in effect, as you said, what we availed in 3B, we are giving a substantiation that it is right. We are not giving the breakup here, but we are verifying and saying that that is right. That is what is the thing. But how do you utilize it? You utilize it only in the return. So if it is eligible, the utilization is always proper. That is why I said utilization doesn't require a reconciliation. Yes, you can take that assumption.
Yeah, I think with that we'll stop, Chairman.
Yeah, thank you. Thank you so much, Shankar, for completing the A to Z, what we promised. And probably 2 days, we have tried to give a maximum of how to cover the GSTR annual return as well as the GSTR audit. Thank you so much, Shankar. Abhishek, over to you for a well-deserved vote of thanks.
Thank you so much, Shankar sir. Really, it is your usual style, your inimitable style, the presentation, and more importantly, the question and answer session is truly illuminating. And the way you are able to cover end-to-end issues with your 360-degree knowledge, that is what I think members really want and we appreciate. It was truly wonderful. Thank you so much for your time. And of course, thank you for helping us coordinate and organize this program also, because under your advice and your guide only we have done this. So thank you so much for that. And of course, thanks to our dynamic chairman, C.A. Dungarchan Jain, for heading all our GST programs or non-GST programs, any programs that we're doing with a smile on his face and, doing it happily. So I have to credit him also. So thank you all for joining in today. Wish you a happy Janmashtami. Stay home, stay safe, take care.
Yeah, only one suggestion to people who are there. You can copy these links which I have shared, and the past programs link, we will be updating that on day-to-day basis so that you don't have to wait for those things to come one. And we'll be definitely sending you the email of all the links. Don't worry on that. We'll be sending you one. In case sometimes the mail may go into somebody's spam or junk box, don't worry. You can refer to this past programs link where everything is available at one place. And very importantly, do give your feedback. It is for the speaker as well as for us to kind of, do an introspection and improve upon. Thank you, everybody.
Thank you.